It's down there. Here's the price action.
Please.
Down 15 on the S&P, 41.53 on the S&P. We declined 0.4%. A weekly loss last week, and we take a little bit more weight off the S&P 500 this morning. In the bond market, yields 162.84, unchanged, and really slap bang on the average since we topped out at 174. So since the beginning of April, I think your average on a US 10-year is basically 162. And Lisa, that's where we are right now.
It's fascinating to me that equities are responding more to the potential increase in inflation beyond expectations than even bonds. And I do wonder how much this is being influenced by Fed purchases, by central bank assets, the fact that they own so many of them. But still, John, I feel like this is going to be an ongoing theme, that risk assets respond more directly to inflation expectations than some of the assets that actually more directly reflect it. Anyway, moving on. What I'm looking at today, 8:30 a.m., we get U.S. May empire manufacturing data. How much are we going to see indications that supply shortages continue beyond May? How much is this going to be a narrative that stretches out for perhaps even into the end of next year and early next year? Perhaps we'll get some indication. Also, we're going to be getting at 10 a.m. some manufacturing on the housing side, the home builder sentiment index data, the idea here of the tight supply there leading to high prices, crimping some of the demand, and that cycle perhaps leading to a little bit less optimism. Then at 10 a.m., Fed Vice Chair Richard Clarida is going to be coming out and headlining the Atlanta Fed conference. How much will he talk about? This is for you, Tom Keene. Transitory. How much will the data feed into his view that perhaps inflation is starting to pick up? And how much will he indicate that the Fed is looking at tapering, possibly at the Jackson Hole Symposium in September, in August? Meanwhile, 1 p.m., Joe Biden will be delivering some remarks on the COVID-19 response. I am curious to see what he says about mandatory vaccines at schools. How much will that become part of the discussion? How much will he talk about vaccine passports? How much will he talk about the new CDC guidelines that have been somewhat controversial in certain quarters for not being strict enough, and frankly, for not being loose enough in other quarters and coming out soon enough, John, as we've been talking about, the importance of being realistic in terms of what people can and cannot do.
Can you imagine playing that drinking game this morning? Transitory.
I think that they're already on the couch.
I imagine it would be absolutely amazing. Can you imagine if we were allowed to play it, actually play it?
I think
TK actually does. I think TK's played it before he comes into work most mornings.
Well, you buy, I'll play.
Okay, I'll be happy to do that one morning. Sebastian Page joining us now, T. Rowe Price, Head of Global Multi-Asset. Sebastian, I can confirm I have not had a drink. Let me just get to this one for you. We're bullish the economy, cautious on stocks, long the recovery trade within stocks. How do we reconcile these views? Sebastian, how do you?
You know, it's hard not to be bullish on the economy, right? We have peak reopening effects right now. The number I keep coming back to is 1.6 trillion in excess savings, which is 22 years of accumulated excess savings in 1 year in 2020. And meanwhile, you now have half the population that's received at least one dose of the vaccine. So this has to translate into pent-up demand. So we're bullish on the economy. The problem, Jonathan, is that everybody else is bullish on the economy.
Yep.
And the stock market, if you look at the price-earnings ratio in isolation, it's in the 99th
Well,
percentile.
Sebastian, I've got to talk about this stock market right now because I'm just getting some headlines. So give me a moment. AT&T confirming the deal with Discovery to merge the media assets. AT&T would get $43 billion in the Discovery deal, subject to adjustment in a combination. Lisa, the headlines continuing to pour out. AT&T holders would get stock representing 71% of the new company, and largely assumed but now confirmed, the Discovery CEO, David Zaslav, would lead the new company, Lisa.
And just to give you some sense of how the market has responded to this, Discovery shares in pre-market trading go even higher. They are now up 17%, just to give you a sense of how much of a boon people think this really is to Discovery, giving them a chance to really compete with behemoths like Disney with their Disney Plus, as well as Netflix, John.
So these are the numbers. $43 billion in the Discovery deal for AT&T. 71% of the new company would go to AT&T shareholders. Discovery holders would get 29%. David Zaslav, the current CEO of Discovery, said to be leading the combined company. So AT&T would get $43 billion in an all-stock deal with Discovery. Richard Greenfield of Lightshed just published moments ago on this, and the headline of it was Zaslav conquers the throne. And in many ways, Lisa, he has done this morning with this deal.
But the amazing thing about the market response to this deal is that both seem to be winners. If you look at AT&T shares, they're up 4.5% in pre-market trading. I mean, yes, it's less than the 17% that we're seeing in Discovery, but what it indicates to me is, again, going back to what Michael Nathanson said, this was a mess. The fact that AT&T is getting rid of it is good. The fact that Discovery could potentially benefit is even better, at least for them.
Sebastian Page, got to turn to you just briefly. And of course, I respect that you won't be able to talk about the details of this deal or the individual components, the individual companies that make it up. But for you, from where you're sitting right now, the media business, does that interest you at the moment?
You know, you've had huge changes in the media business in 12 to 18 months, right? And especially through the pandemic, you were just talking about streaming and digitization of entertainment. These changes are here to stay, so it will create winners and losers. Jonathan, you were also saying you have 3 or 4 services and it's starting to feel like a lot. I feel the same. You keep signing up when you're stuck at home, but at some point you rationalize that. I think that we've had structural changes through COVID in the media business across the board, and that you are bound to see some M&A like this out of this, and those changes are here to stay. And it's kind of like the inflation discussion. You get peak change and then you settle back to a new level that's kind of higher as well. So a new level of digitization, streaming, and so on, that's higher than it was before.
Sebastian, you're talking about the mergers and acquisition activity that we're likely to see ongoing throughout the year, especially given the cash piles that companies have. Is this a good use of that cash? As an investor, do you generally like to see this at this point in the cycle?
You know, there's a long history of M&A activity that was not successful across industries. Those deals aren't always successful. There are always huge promises of cost cutting and huge promises of efficiencies, but they're not always realized. So really, you know, at T. Rowe Price, we have a lot of talented stock pickers, and it becomes a security selection, and you look at every deal in isolation. It's kind of like we're looking at investing in value these days. It is the revenge of the stock pickers, if you will. It is a stock pickers world. So I don't think you want to make broad statements on whether it's a good use of cash or not. It really depends on the deal. The bottom line is that there's a lot of cash in the economy. There's a lot of cash on balance sheets, and this cash will get deployed one way or the other.
Sebastian, we got to run, and apologies for the interruption, sir. Sebastian Page there of T. Rowe Price. This was the interruption, and this will be a top story for us through the morning on Bloomberg TV and on Bloomberg Radio. AT&T confirming a deal with Discovery to merge media assets. The numbers coming through as follows. AT&T would get $43 billion in the deal with Discovery. 71% of the new company going to AT&T holders. Discovery holders would own 29%. The stock price up by 3.75% on AT&T. Discovery, as Lisa pointed out, surging by 17% in early trading. From New York City this morning, good morning. More still to come. Alongside Lisa Bravitz, I'm Jonathan Ferro. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. Israel has stepped up its attacks on high-ranking commanders in the Hamas movement that rules the Gaza Strip. No word on casualties yet. Israel said it attacked terrorist infrastructure and weapons storage locations. Meanwhile, Hamas continued to fire rockets at civilian areas in Israel. The U.S. and other world powers have called for an end to the violence. Israel's Prime Minister Benjamin Netanyahu said action will continue as long as necessary. The European Union has reached a truce with the U.S. over metal tariffs. The result, iconic products such as Harley-Davidson motorcycles and bourbon whiskey won't have tariffs, doubled next month. The dispute began in 2018 when former President Trump imposed duties on steel and aluminum from Europe, Asia, and elsewhere. The EU retaliated. Now the two sides have agreed to discuss the metals issue. The chances of President Biden getting an infrastructure bill through Congress with support from both parties are rising. As early as today, Senate Republicans are set to deliver a revised offer that includes roads, public transportation, and airports. Still, disagreement over how the legislation will be paid for could kill any deal. And more revelations coming out in the wake of Bill Gates' impending divorce. Microsoft conducted an investigation into Gates' involvement with an employee almost 2 decades ago after being told in 2019 that he tried to start a romantic relationship with her. The company investigated but didn't reach a conclusion because Gates stepped down from the board. A Gates spokeswoman did say that he did not leave because of an affair. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between governments and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
We're seeing the clash.
Okay, traders, as you can see, we need to place stop and profit for Bitcoin. The price I'm looking to sell, if it will change direction, 44,649. Okay, I'm placing a stop on profit at 44,649. So you guys, all of you who decided to buy Bitcoin and follow my trades, please copy this trade, please follow this until the end, and whatever happens, you will close this trade in profit. If it will move further, we will, of course, increase our profit. Okay, I'll speak to you later.
Up by 17%, and just getting a little bit of detail on the numbers, Lisa, in the last 10 minutes as well. AT&T would get $43 billion in the deal with Discovery, and I understand we have a news conference coming up in about 12 minutes' time.
What I think is interesting is that both the AT&T and Discovery see the deal creating at least $3 billion in cost synergies. What does that mean? Does that mean cuts in jobs? Does that mean that they're going to be able to reduce overhead that somehow doesn't lead to job cuts? And is that enough to justify the deal? These are some of the questions that people will be having as they parse through the details.
If Tom was here this morning, Lisa, he'd be pushing back aggressively against the word synergies.
Yes, he would.
He absolutely hates it because it often means job cuts.
Correct, and it basically is a way to sanitize that idea. But where would they be cutting jobs, right? I mean, here are the questions, because there isn't that much overlap, theoretically.
Understand. Here's some headlines elsewhere from Hong Kong. Just briefly, Lisa, would like your reaction to this one. Hong Kong and Singapore have been trying to put together some kind of travel bubble for a long time now. Hong Kong to require 21-day quarantine for Singapore arrivals. Hong Kong classifying Singapore as a high-risk virus destination. And it's worth pointing out, Lisa, and re-emphasizing, as you have done through the whole pandemic, the tolerance levels of places like Singapore and Hong Kong are markedly different to places like London, New York, the UK, and the United States.
If your tolerance level is that a cluster is considered 5 cases, how are you going to reopen internationally at a time when COVID-19 is being treated increasingly like the common cold or the flu, and it's not going anywhere? What will it take to sort of move beyond that? And frankly, it's hard to see at this point, given some of the vaccination rates and frankly some of the efficacy rates that we've seen in certain select vaccinations.
Some of the big headlines crossed on the Bloomberg in the last 20 minutes then. Hong Kong classifying Singapore as a high-risk virus destination, requiring a 21-day quarantine for arrivals from Singapore. Let's turn now to Washington, D.C. Emily Wilkins joins us now from Bloomberg Government. Emily, we've spent the first hour 20 minutes of this program talking about the big business stories. Let's talk about the big global story over the weekend, the tension between Israel and Hamas. What is the latest this morning, Emily?
So President Biden reached out to the leaders in both areas over the weekend, speaking with both Prime Minister Benjamin Netanyahu from Israel and then the Palestinian Authority President Mahmoud Abbas, and urged both of them to sort of have a ceasefire. He called for peace. President Biden has continued to sort of have the line of saying that Israel does have the right to defend itself. And as he's become under more pressure from within.
Moving further, stop and profit for Bitcoin. And I'm moving to 44,782. It will give us 500 pounds in profit, 0.5%. If you remember, I told you how our profit based on percentage, 0.1, 0.2, 0.3, and so on. So we moved to 0.5% in profit, and let's see, and I think we will move even further. Let's see, 44,000. I think we will move to 45,005, 45,005. Let's see. Yep. Okay, it will give us 1% already in profit. 45,000, it's a little bit more, 0.05, like this. Okay, well done, good trade, guys. Please place stop and profit at the price I pointed out if you follow my trade, and let's move on. Let's see how far Bitcoin and how much profit Bitcoin give us. Stay safe, guys. I'll speak to you later.
With other leaders and how they unify approaches to the situation.
Well, the U.S. has been working with Egypt as well as other players in the area to try and bring about a ceasefire, but the U.S. has also recently come under condemnation. I mean, it's part of the United Nations Security Council. The Security Council has now met 3 times on the Palestine-Israeli conflict, and they have yet to put out a joint statement because the U.S. has not agreed to it. It has to be unanimous. And so you started to see other countries' officials at the UN, including the Chinese official, come out and really begin to criticize the U.S. for holding up progress here in calling for peace in the Middle East area.
All right, Emily, other than a proclamation, what are the potential implications? What could the U.S. potentially do with respect to taking action in a situation in the Middle East that could be a likely outcome of the fighting that we've seen?
I mean, there is a lot that President Biden can do to sort of reverse some of the policies that were implemented under former President Trump. I mean, one thing that happened under President Trump is that there was no longer any foreign aid given to the Palestinians. President Biden has gone ahead and reinstated that. I think a lot of this is also going to see what Congress winds up doing this week. They didn't really act on this issue a lot in the previous week, but they're still here, they're still in town, and there still is a sense that maybe they could wind up doing something as far as funding goes, or even, I know it doesn't have a ton of weight, but having some sort of resolution coming out and really firmly stating where the U.S. Congress is at this point.
Emily, just quickly, the president's first trip aboard as the president of the United States, the first overseas trip, is next month. It's Europe. As things stand right now, where is the emphasis for that trip?
I think the emphasis is once again on rebuilding those allies, strengthening those connections with countries abroad, particularly after former President Trump really sort of pulled back on a number of them. So President Biden is hoping to increase his allies in Europe, and that way he can sort of better take on countries such as China, who he sees as a bigger threat.
Emily Wilkins there of Bloomberg Government, thank you. And of course, a little bit earlier on this morning, the headline that the EU and the US announcing a temporary tariff truce in the metals dispute. Maybe just cleaning house a little bit, Lisa, going into this meeting next month.
With this whole issue, and we're just going back to the whole issue within the Middle East, highlights to me some of the fissures within the Democratic Party. The fact that some within the Biden administration are actually pushing back on the fact that he hasn't acted quickly enough, and it really raises the conundrum of how much of the fiscal plan that he announced could get passed, given some of these limitations on consensus.
Yep, some of the stories down in Washington, D.C. as this administration faces its first big foreign policy test. From New York City this morning, good morning. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Your S&P 500 of 41.51 and down 0.4% now. Yields creeping just a little bit higher at 163.52. And Discovery absolutely flying in a deal with AT&T. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Of our lives, for work, for learning, for communicating, for staying in touch.
Waking up Monday morning with a little bit of deal flow. We'll talk about that deal flow in just a moment. From New York, this is Bloomberg Surveillance live on TV and radio, and here's the price action this Monday morning. The S&P 500 coming off the back of a week of losses. We take more weight off the S&P, down 0.4%. The Russell down 0.8. The Nasdaq down 0.4%. And it's a struggle, some tension between how we want the world to be versus how it is. Some tension, I've called it a duration mismatch between our vaccine-fueled desires and just the basic mechanics of getting supply to meet them. Maybe that's why we've seen downside surprises to output and upside surprises to inflation, reflecting that supply-demand mismatch right now. In the bond market, it's meant one thing, a volatile move through last week, just a story of two halves, and back down to basically the average of the last couple of months. Since we've closed at 174 at the back end of March on a US 10-year, on a closing basis, your low's been 154, and your average been 162, 163.35. Pretty much at the average. Yields this morning just inching a little bit higher on 30s to 234.59. I used the word inching on treasuries. I will not use that word for Italy. Let's finish on this. The Italian bond market, the German bond market, yields have been creeping higher in Germany back towards zero. We're negative about 11 basis points on a 10-year, and on the session, we're up a couple of basis points today. In Italy, we're climbing now for a fifth straight session. Earlier this year, in February, we were south of 50 basis points on an Italian 10-year, and now we are through 1% to 1.137%, and yields are up another 7 basis points. If I was looking at the sovereign debt market right now, that's where I'd be laser focused going into next month for the ECB meeting. An Italian 10-year at 1.137%. That's the cross-asset story. Stateside, there is only one story this morning, Romain Bostig. Yeah. We got a deal.
Yeah, absolutely. AT&T, Discovery, the whole spinoff here. If the folks over at Warner Media want an idea to put on their streaming platform, they can maybe do a docuseries about all the iterations that Warner Media has been through. You go back to the old Ted Turner days in the 1990s. Of course, you have the big AOL deal at the turn of the century. You, of course, remember a few years back, you had that whole bidding war that Rupert Murdoch when he was trying to gain control of this. And then, of course, the purchase by AT&T of these Warner Media assets in 2016. A new CEO for AT&T in 2020. Stanky coming in, taking a look at that and saying, look, if you're not number one or number two in an industry, get out. And right now, they were not even number three, barely even number four. And in fact, their wireless business that AT&T has was slipping from the top position down to the number 3 position. They had a big decision here. Do you focus on one thing, wireless and 5G, or do you try to maintain this sort of combination of all of these different assets? The solution, of course, get rid of Warner Media, spin it off into a new company. The head of Discovery Media, he's going to be heading this company when it's all done. Right now, Discovery shares halted. They were up about 17% here in the pre-market, set to reopen around 740. I'm told AT&T shares higher by about 4%. And Viacom CBS, of course, which has its own streaming platform, and a lot of speculation around where that's going to go, up about 3% here in the pre-market as well. We should also point out Viacom shares getting a little bit of a boost off the latest 13F filings that showed Soros Capital and a few other big funds taking a stake in there. There is another big story out there today, and of course it's crypto, John. We had, of course, all the rumblings over the weekend. A one-word tweet by Elon Musk, once again, sort of upending the market, down about 10% on the major coins over the weekend. Tesla down here in the pre-market by about 1.6%. A lot of concern here is less about what this means for crypto coins themselves, and really the idea that a lot of companies have started to put this thing on their balance sheet, and the idea of whether they're as committed to it as some of them seem to make out. Of course, MicroStrategy seems to be the most committed to it of all. Michael Saylor has been the main evangelist for this. He's the one who said he actually convinced Elon Musk to put this on Tesla's balance sheet. We'll keep an eye on this, but keep an eye on that, Square, and a few other names in this space, John, all down in the pre-market.
Romain, thank you. Before you go, can we just talk about media assets in America just quickly? From a personal perspective, and I want your opinion, have we got too many streaming services now?
Yes,
Are you in the business for another one? Because most people I talk to are in the business to take one away and another one after that.
Well, I mean, I think a lot of us amassed a lot of streaming services. 3 years ago, I think we had 1 or 2 in our house, and we've pretty much got them all on our TV set now, along with the monthly costs there. And I think that's the issue here, is people are starting to look at this and say, okay, you could have Netflix, maybe you have Disney Plus. Do you really need HBO Max? Do you need Hulu? Do you need all these other things? It'll be interesting to see whether some of these things do get consolidated beyond just the Discovery Warner Media tie-up. Remember, there's like, I think I saw one stat, there's something like 80 different streaming services out there right now, including, of course, Bloomberg Media, which definitely don't get rid of that.
I agree with that, Romain Bostic, and I also know the Bostic household does not watch TV, because I saw what you were doing over the weekend. A bit of vinyl.
I was.
I appreciate that.
Absolutely.
Romain Bostic, thank you. Back for the close a little bit later on Bloomberg TV with the team. Looking forward to that. Lisa, just quickly, we mentioned this a couple of hours ago. Romain Bostic just mentioned it then, that George Soros bought into some of these assets, but they were stocks that were previously owned by who? Bill Hwang. A couple of months ago when Archegos blew up. If he could have held on just a couple more months, he'd be having a good morning this morning.
He would, but he didn't. And this is the problem with leverage. This is the problem with having yourself on the hook, where you don't have the flexibility to hold on, even if you have belief in a company, John. And that's basically what we saw with Bill Hwang.
Discovery absolutely flying this morning. Your equity market down 15 on the S&P 500. Joining us now, I'm pleased to say, it's Vince Reinhart, Mellon chief economist. Vince, it is tough for economists right now to get a decent read on this economy and come up with an estimate for what happens next. Let's just start there. How difficult it is to forecast this economy at the moment, Vince.
Oh, inflection points are terrible. Remember, G-forces come into play when you're making a sharp turn, and we are definitely on the upside of the V for activity, to the point that we have to worry about, technical matters and things that macroeconomists just usually wave their hands over. Importantly, bottlenecks. You opened it well. Just go back to Friday's data for the U.S. Industrial production, good, but a little disappointing because of bottlenecks in the auto industry. Then we get the Michigan Inflation Expectation Survey with the eye-popping increase in the 1 year ahead inflation expectations. And 5 year ahead, 3.1%. That sounds to me like above the Federal Reserve's goal.
We have higher prices. Vince, a question some people are asking, I'll ask it of you. Do you have any sympathy for the argument that higher prices now, whether they are driven by bottlenecks, supply issues, etc., lay the foundations for higher prices in the future?
I think that's the risk. The Fed's bet is the effects of, the effects of base effects and bottlenecks will be a temporary increase in prices, but it doesn't change the trend. The thing you should worry about is there are increases in prices of goods and services that are very salient to households. Just ask somebody about how much it costs to fill up the tank of gas, or how they're doing in getting plywood, or is their new car coming in. Those price increases may lead them to increase inflation expectations, and increases in inflation expectations to use the Fed's favorite phrase, is what anchors inflation. So if expectations go up, we'll get a re-anchoring to something above the Fed's goal.
And Vince, just to see how this could play out, it leads to people demanding more in wages or holding out for a higher salary because otherwise they cannot afford the basic staples that they go out and they buy every day. How much is what's happening? I mean, people often say that it's people on the lowest tier of income that get hit the hardest when you get this kind of inflation. Is that still true this time around, given some of the price increases, the wage increases that we've seen, particularly on the lower end of the scale?
Okay, so generally, inflation is thought to be very regressive. That was the lesson of the 1970s, because people with more income and more wealth can figure out ways to shield their assets from inflation effects. And they probably have more pricing power to reset their own wages and salaries. Not so at the lower end of the income spectrum, because low-income people also just don't have a whole lot of wealth. So inflation is pretty pernicious in that regard. And has it changed? No, not really. Income inequality's only gotten worse. So one would think that meant that the rising part has even more means to shield themselves from inflation. In fact, inflation is going to be eating into the real wages of low-income households.
Is inflation going to lead to this sort of virtuous cycle where people actually spend more of their money, since it's probably going to be worth more now in goods and services than later? Or is it going to lead to a dampening effect on the economy, like what we're seeing in the housing market, where you're seeing the actual sales slow due to the high prices?
So those high prices probably reflect the inability to actually get all those goods. Think about the empty auto lots that are both slowing car production, outright decline last month because they can't get the chips, and auto sales, but also leading to price increases for used cars. That's the bottleneck effect. There are two other effects. One is timing. As you say, if you think prices are going to be higher next month, don't you want to buy the good or service this month. Households have a lot of wherewithal to spend, so what that may mean is the boom part of our rebound is even more vigorous. Then the last effect is the more permanent one, which is people just spend resources trying to avoid the effects of inflation. And that's just, as economists say, a dead weight loss.
Vince, always great to catch up with you, sir, on the story of the moment, and send our best to Carmen, won't you? Vince Reinhardt there, Mellon chief economist. Thank you, sir. Bit of deal flow we need to talk about. Discovery, that stock is trading again up by more than 18% as they come to an agreement for the media assets of AT&T. There will be a merger between the two, Discovery and AT&T's media assets coming together. There is a call right now, a conference call, a presentation from the AT&T CEO, John Stankley, and of course the Discovery CEO, David Zaslav. Those comments continue to pour in. And Lisa, the Southside research as well. I talked about Citi upgrading Discovery to a buy from neutral. Rosenblatt Securities had this to say: the deal could put Discovery shoulder to shoulder with Netflix and Disney Plus seemingly overnight. Their quote, not mine, quote, shoulder to shoulder with Netflix and Disney Plus seemingly overnight.
And if you take a look at Netflix shares, they're actually down 1% or 1.1% in pre-market trading, so perhaps responding to this idea that they are going to be facing a behemoth competitor, although it does seem like this does seem to be received as a win for both AT&T and Discovery in the stock market.
A bigger win for Discovery.
Absolutely.
I think it's clear and obvious to say.
I think that's fair.
I'll point that out anyway for our listeners on radio. We might not be able to see the share price up by almost 18%. AT&T up by about 4.56%. Coming up in about 20 minutes from now, Lisa Hornby, Schroders head of US multi-sector fixed income from New York City, alongside Lisa Abramowitz. I'm happy to say she's back. Tom Keen's going to be back tomorrow, so finally the band comes back together. You'll have to wait for that tomorrow morning. Futures 41.53, futures down 0.4%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. A huge deal in the media industry today. AT&T will get $43 billion under an agreement to merge its media assets with Discovery. The deal creates a company with channels ranging from CNN and HBO to HGTV and the Food Network. And it marks a retreat for AT&T's entertainment industry ambitions after years of working to assemble telecom and media assets under one roof. Israel's Prime Minister Benjamin Netanyahu signaled he's not ready to let up on attacks against Hamas positions in Gaza. More than 200 people have been killed, the vast majority in Gaza. Netanyahu says he'll do whatever it takes to restore order. Constant rocket attacks from Gaza have led to retaliation from Israeli warplanes. Western and Middle Eastern leaders are trying to solve the crisis, but have little to show for their efforts. And Irish discount airline Ryanair posted a record loss in the latest fiscal year, but the carrier says it's likely to break even this year. The reason? Lockdown-weary travelers who can't wait to go on holidays this summer.
Most European countries are predicting that they'll get to about 80% of their adult populations with at least first dose vaccines by the end of June. So we think we're looking at a very strong July, August, September. We think the booking trend over the last 6 weeks clearly supports that.
Ryanair posted a loss of $989 million for the year that ended March 31st. And it's another step towards getting back to normal for JP Morgan. The nation's largest bank is reopening offices to employees across the U.S. today. It's part of JP Morgan's plan to call back its entire U.S. workforce, at least on rotations in July. The bank's reopening will probably be closely watched by other big financial firms, which may then adjust their own plans. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Okay, ladies and gentlemen, I have to move further my stop and profit for Bitcoin to 45,228. Okay, 45,228. I will adjust later on. It will give us 1.5%. Please move your stop and profit if you decided to follow trade from the beginning, just about what? About 45 minutes ago. Please follow me and you're already in profit. Okay? Stay safe.
It's such an interesting new world. The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
The importance of computing in all products is just going up and up and up.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
demand is definitely there. There's a huge and pent-up demand here for people to come and see family members that haven't been able to be meeting across this pandemic, as well as people who wants to go on holiday as well. So the demand is definitely there. Now it's down to unwinding the restrictions to restart travel in a safe way.
The demand is there. How many times have we heard that? We know the demand is there. Johan Lundgren there, EasyJet CEO. It's whether you can actually meet that demand with supply and whether you're allowed to bring that supply back online because you're actually able to travel to those countries. Lisa, let's just go through some of the headlines right now from the UK. We don't want people holidaying in amber list countries. I'll translate that. We don't want people going on vacations in countries that aren't on the green list. So you have this traffic light system that Bloomberg's Emma Chandra went through quite nicely earlier on this morning. If you're on the green list, great, you can go, come back, don't need to quarantine. If you're on the amber list, you need to come back and do a little bit of that. And they're saying we don't want people holidaying on the amber list, and we can't yet make a definitive call on the June 21st reopening. Lisa, once again, this is not about demand. I've got a ton of family and friends back in the UK. The demand's there. They want to move. They want to travel. They want to go on holiday, on vacation. It's whether they can or not.
And how do CEOs range their inventory around this type of guidance, right? How do they prepare enough jets to ferry all the people who want to fly and want to vacation in these different countries if they don't know what the guidelines will be? And frankly, it's a moving target. I mean, it just sort of highlights the frictions that we see on an ongoing basis as the reopening continues.
Let's talk about some of the frictions in this market. Dave Wilson back from vacation, I'm happy to say. Bloomberg Stocks editor. He joins us this morning with his chart of the day. Morning, Dave.
Good morning, John. Yeah, I'm here to talk about a comparison that Michael Hartnett made, the global chief investment strategist at Bank of America, the other day, really kind of touching on the whole question of growth stocks versus value stocks. And it was how he illustrated it that was, shall we say, a bit different. He made a comparison between ARK Investment Management's flagship fund, ARK Innovation, and Berkshire Hathaway. And then he did the same in the 1990s going into 2000 and beyond with Invesco, which managed a whole lot of the high-flying tech funds of the dot-com era, relative, again, to Berkshire shares. So really, when you take a look at this comparison, it kind of shows you that history is, at least to some extent, repeating itself. I mean, which is really Hartnett's point. The whole idea that, here we are, we've had this high-flying growth fund, Cathie Wood's flagship, and it's done really well over time, but not so well this year, as you can see, or at least the past month, as you can see in the chart. And Berkshire, it does what it does. It sort of plods along and, up about 7% this year. So, it's sort of consistent with the idea that we've had this transition away from growth and toward value, and we've seen this story before. And it's really a matter of Hartnett kind of focusing on company-specific examples as opposed to, say, growth indexes versus value indexes.
The spread, absolutely huge through this year, Dave. And I think underlying, that's where your performance this year is going to come from. Where were you positioned? Dave, thank you, sir. As always, Dave Wilson there. Shout out to Miles over at Yahoo Finance, the first guy that I saw point this out this morning, Lisa. The number of times that the Warner Media CEO, Jason Kilar, has mentioned in the Warner Media Discovery press release. Do you know how many times?
How many times?
0. Not mentioned at all.
A changing of the guard. And it's very clear that there is going to be a revenue sharing model for this combined asset. However, it is Discovery very much in the driver's seat.
David Zaslav taking over that combined entity. The $43 billion that AT&T will receive, where will it go? And how big are the buybacks this year already? Gina Martin-Adams joins us now from Bloomberg Intelligence, Chief Equity Strategist. Gina, can you walk us through the buybacks, just the tally so far? How big is this year?
Yeah, well, this year is just a climb out of a hole created by 2020, to be honest. We're just barely working our way off of 2020 lows. We did see companies start to announce new buybacks throughout the first quarter earnings season, but frankly, we've got a long way to go. Just to get back to buybacks as a share of sales for the S&P 500 in line with long-term average, we need to see about 50% growth in buybacks in 2021. We're not even quite half that level so far with the first quarter announcements. So we've got a long way to go. We are working our way back to a more normalized environment of cash deployment, but we're nowhere near where we were pre-pandemic. which is probably where we head ultimately over time.
Okay, Gina, so riddle me this. We're seeing companies increase their share buybacks. We're seeing them increase their dividends on a number of bases. We're seeing different ways of them giving money back to shareholders. And yet stocks have been consistently more sensitive to inflation expectations than even benchmark treasuries. What do you make of this?
Yeah, I think that stocks are naturally going to be sensitive to inflation expectations, but also they're going to appear more sensitive to inflation expectations than anything because of where we are at the stage in the cycle. We're at a point where you see natural rotation into cyclicals coming out of trough lows, coming off of economic base lows. You generally see cyclicals start to lead. Cyclicals are inflationary plays. So the cyclical leadership gives you a sense that the market is definitely more sensitive to inflation. At the same time, we had this incredibly anomalous situation develop over 2020 where defensive sort of interest rate sensitive, inflation sensitive segments like the FAMIC stocks, like the big cap tech stocks were leading, which is somewhat odd in the first year of recovery, and it really reflected this more defensive sort of uncertainty that was out there. There was certainly at this time last year no belief that inflation was going to accelerate despite the fact that we were at our economic lows and starting to move higher. So some of this is just a lagged response,
right,
where we're seeing this rotation drive performance and getting the sense that the market is extremely sensitive to inflation.
Right.
What really is happening is we're reinflating, and that's where the market sensitivity lies, and then some anomalies that developed in 2020 that need to ease off.
Gina, we just have about 20 seconds. What's your expectation in terms of the AT&T and Discovery deal being indicative of the incredible M&A wave that we expect to see through the remainder of the year?
Well, I do think that M&A is definitely one form of capital deployment that we're going to continue to see. Companies want to see growth. They want to buy growth. They want to create growth. And M&A is going to be a natural outlet for capital.
Gina, got to leave it there. Gina Martin-Adams there, Bloomberg Intelligence Chief Equity Strategist. That press conference ongoing between AT&T and Discovery. The CEO, John Stankey, saying the following: the Warner Media CEO, Jason Killar's future to be determined. Lisa, that's not a nice thing to wake up to, is it?
Yeah, to me, that means it's a nice way of saying
I don't think it's a nice way of saying anything.
He's not going to be there. I'm just going to go out on a limb here. I mean, if someone told me that my job was to be determined, I would think, okay, start to polish up that resume. I'm just saying, theoretically.
I know, I hear you. Coming up, Lisa Hornby, Schroders head of U.S. multi-sector fixed income, and much more reaction to the deal of the morning as AT&T is looking to shed its media assets and put them together with Discovery. That deal approved. Futures 41.49 on the S&P. We're down 19. We're off by 0.5%. Yields unchanged on 10s at 163. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom King back with us tomorrow. Live on radio, on TV. This is Bloomberg Surveillance.
traffic.
Okay.
During the pandemic, no traffic at all.
Okay. Where do you see the oil market in about 20 years or so?
Non-existent.
Have you ever thought of bottling your happiness? And you know, you could make a lot of money if you bottled your happiness.
Yeah, you know what it is? It's just gratefulness. I should have died in that field in Iraq.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The global economy is being driven by U.S. exit from COVID restrictions.
No, we're not done with the adjustment to a shock. Big shock down, big shock up.
People, they don't like inflation. This is true, but they will tolerate it to a moderate level.
It's very difficult to take a wage increase away. And so I do think that wage growth could be a little bit stickier.
Transitory gives the impression of over and done very quickly. I don't think that's what we'll see. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Tom Keene back tomorrow. Equity futures down 20 on the S&P 500. We declined by a couple of tenths of 1%. Your story of this morning, Discovery and a tie-up with the media assets of AT&T. And Lisa, Discovery this morning, absolutely flying.
And rightly so. I mean, the idea here is that they're going to be potentially presenting competition to the likes of Disney Plus and Netflix at a time when streaming reigns supreme. Of course, the big question going forward, how much are people going to actually have multiple lines of streaming in a post-pandemic world where you can actually do stuff?
Let's talk about the share price. Where's AT&T right now? 33. Where's Discovery? Discovery closed almost at $80 earlier this year. Now, my question this morning is how Bill Wang would have felt this morning if this deal got done. And then you look at the share price and you wonder whether this deal or these talks would have even happened if Archegos hadn't even blown up, because Lisa, Discovery is still trading at half the price it was 3 months ago.
The idea here is have valuations in stocks, certain stocks, been
Totally
depressed
reset.
enough, right, reset enough to create some of these opportunities. I think it's an excellent point. It's a great question. And on the flip side, there is a question of how much M&A activity can get done in some of the high-flying stocks, particularly in the cyclicals, given where valuations are now versus how much they could potentially have room to increase as this cycle drags on.
So we're learning about the numbers this morning that AT&T shareholders would get stock representing 71% of the new company, the other 29 going to Discovery holders. Also learning a little bit about the leadership as well here, Lisa, that David Zaslav looks like he's topping the throne of this company. And the Warner Media CEO just does not get a mention. There was a press conference that started about 32 minutes ago or so, and the AT&T CEO saying that the Warner Media CEO, Jason Killar's future is to be determined. Now, one man who hasn't got a mention so far this morning is Mr. Stevenson, the former AT&T CEO. Now, let me tell you up front, running a company is really, really difficult. This is not me throwing any shade at Mr. Stevenson, but this morning is about unwinding the failed strategy the failed acquisitions of a former CEO.
And then there's a question of how they use the cash infusion that they're going to be getting, the $47 billion that they're going to be receiving. Are they going to pay down debt, and will they end up more leveraged post-transaction than they were pre-transactions? How much does that affect their potential to adapt to the 5G environment, especially if there isn't necessarily an infrastructure plan that's passed?
Very true. We're going to touch on that in just a moment. We'll get the fixed income side of this story for you. As we carry you down to the opening bell, about 1 hour, 27 minutes until the cash open. Futures are down 19 on the S&P. We declined just a little bit, off by 0.4%. Into the bond market, yields 163.35 on 10s. Basically unchanged this morning too. Euro just a touch firmer, stronger. Euro dollar higher to 121.50, up about 0.1%. And just to round things out on crude, Lisa, about $65.13 on WTI. We're down about 0.4%.
I feel like I have to channel Tom Keene a little bit just because he's not here today. When you talk about how the 10-year yield is unchanged, I was taking a look at the real yield. Oh my goodness, it got really negative over the past week or so. When I was gone, it got
missed you.
Evidently. But it raises this question of, are you going to see the move in real yields and not in nominal yields? And is this basically indication that the Fed is keeping its thumb on valuations completely and that it's not reflective of where inflation expectations are?
Well, I imagine that over the weekend, as you were looking at the price action, you would have seen the break-evens breaking out, inflation expectations picking
highest
up, and
since 2000.
Real yields just going the other way, Lisa.
Yeah, I know. It's interesting, though. I just thought I would mention that with the nominal yield so boring. It's not boring everywhere.
I'm not saying it's boring.
No,
just
I know.
Unchanged.
I mean, but Tom would.
Tom would.
Nobody
Tom
cares.
Would. No,
Go to cash.
The voice is deeper than that.
Go to cash.
Right.
Okay, go on.
Nobody
Carry
cares.
on.
It's like that, all right?
I don't
Lisa
think we should do
Hornby
this.
joined us now, head of
Please
US
save us.
multi-sector fixed income over at Schroders. Lisa, I'm not going to make you do an impersonation of my good friend Tom Keene. Here's a headline that crossed about an hour ago. Discovery says it's committed to maintain investment-grade ratings. As you look across the C-suite in corporate America right now, do you see a lot of that? People looking to defend their credit ratings after piling on the debt over the last year?
Yes, actually, and I think it's particularly true for some of these low BBB rated companies. I mean, I think if you look back at what happened last year with the Fed, they essentially gave a lifeline in the pandemic to any company that was investment grade at the start of the pandemic. So that does, in our view, incentivize companies to maintain that BBB rating and hold on to it, which is why we're actually a bit more positive on BBBs at this point than we are on some of their higher rated single A counterparts who have a little bit more financial flexibility to potentially do some of these large M&A transactions, be more friendly to equity shareholders, and not protect their balance sheet quite as much.
Lisa, is the same true of BB? And for people outside of fixed income and maybe not institutional investors, cross-asset, not familiar with this dynamic, you have a series of credit ratings. The line in the sand between investment grade and high yield or junk status is that BBB to BB, that line between the BBBs and BBs. And Lisa, I'm wondering if the same is true of BBs for the upgrade potential from junk to investment grade, or whether that trade is already done.
I think that there's still a number of them to come. There are some opportunities in the high yield space where we think there are attractive upgrade candidates just because the recovery is going to be quite strong. I think there are some companies that potentially do want to fall or have been fallen angels and want to come back into the investment grade universe. So at this point, yeah, I think there's probably more upgrade candidates in the high yield space than downgrade candidates, certainly.
Although Morgan Stanley just downgraded credit to neutral as far as their allocation recommendations, and they were citing this hotter but shorter credit cycle that they keep talking about, and that a lot of people are signing on to, the idea that inflation will really hit some of the weakest players here at a time when their assets are priced to perfection. Would you agree with that?
Well, Lisa, you brought up a number of points. So first of all, in terms of credit overall valuations, I mean, you can't make an argument and say that anything is attractive. Certainly broad brush, you look at valuations across the investment grade and the high yield universe, and essentially we're in the bottom decile, meaning things have been much cheaper much of the time historically. So quite clearly, this is not a fist-pounding market in credit anymore, very different than where we were 6 months ago. That being said, there are still some opportunities, idiosyncratic opportunities, as we say, upgrade candidates, but you cannot paint the market, particularly the high-yield market, with a broad brush.
Okay, when you talk about idiosyncratic opportunities, it doesn't necessarily lead to an overall portfolio that can do more than clip coupons, especially at a time when the margin for error is so low. The cushion on any increase in yield is so narrow. How are you sort of preparing your investors in terms of expected returns, in terms of the potential pitfalls of investing in credit at this moment?
That's a great point. I mean, we are much more defensively positioned. We're still somewhat constructive on investment grade credit, but much less so than we have been over the last 3, 6, or 12 months. So, you think back to March of last year, it was a, basically once in a decade opportunity to buy very cheap names, and almost didn't matter what you bought, as long as you bought something with spread on them. The market environment today is almost completely the opposite. There are very few names out there that look very attractive. This is certainly not a beta-driven market anymore, meaning we have to work a little bit harder to find the opportunities, make sure we understand the credit profile. As we say, some more idiosyncratic stories, maybe a little bit more thematic in nature, but certainly not broad overweights to the high yield or even the investment grade sector.
Lisa, just quickly, what's your position in Italy right now? You and I have talked about this in the past. Where are you right now?
We actually don't have a position in Italy. I mean, we've seen yields move, so low recently. It's just, we prefer to take our duration positions right now in the U.S., so we don't have any cross-market trades on. We are modestly short duration in the U.S. market. We do think that rates have this relief rally, let's say, that we saw over the last couple of months is probably set to fade a bit as we see this inflation data come through a bit more strongly, I think, than people have been expecting, even though the narrative of transitory inflation has been out there for some time.
It's not taken a hold of the Italian bond market, that's for sure. Yields moving the other way. Lisa, thank you. As always, Lisa Hornby, Schroders head of US multi-sector fixed income. For all the talk of transitory and the ECB being in for a long time, buying more, Italian bond yields are heading north. Just want to bring you a comment from Sarah Fisher of Axios on this Discovery AT&T's tie-up. Here's the quote, Lisa. The CEO, David Zaslav, just said they're going to start by investing $20 billion in content. That's notable in that it's more than what Netflix spent on content last year, roughly $17 billion. To make this a success, you have to spend a tremendous amount of money on content, and clearly that might be the intention of the Discovery CEO.
And the idea here is, will it be worth it, or will this be an ongoing mess as we try to refigure the idea of where media is today, how many streaming services a person has? How many do you have?
I have, I've lost count, 3, 4?
I have at least that.
If I tally them up, 4. And I think I maybe need to make some cuts as well. And I know I'm not in the same, I know I'm in the same boat as a lot of people who are thinking about the same thing after last year. And I think it's also notable. Netflix, big miss on subs. What do we have from the Walt Disney Company last week? Streaming, big miss again. And I caught up with Moffat-Nathanson last week. We did on this program. And Michael Nathanson said that is payback for pull forward last year. Now, it's only 1 quarter, but the timing of this is interesting.
But the idea of the stock reaction, that actually you are getting punished for not taking bold moves, that if you take bold moves that could potentially pay off, you are being rewarded, indicates where we are in the economic cycle right now, given how much cash some of these companies have on their books.
That right there is a bull market. Bob Profusek joining us now a little bit later.
Well said.
Jones Day, Global Chair of M&A. He'll be joining us in about 10 minutes' time. Your equity market on the S&P 500 shaping up as follows on the S&P. We decline 19 on the S&P, down 4.5% into the bond market. Yields unchanged at 163.18. Although, as Lisa tells me, it is not boring.
No.
Negative yields on a real yield, deeply negative. Took you a while. It took you 2 hours and about 11 minutes.
To interrupt you?
No, not to interrupt. No, I don't care about that. No, just to be a little bit bearish.
Oh, I've got bearish views still, but I went on vacation, so I'm happy.
I know. I give you another 10 minutes. The old Lisa will be coming back. From New York, this is Bloomberg.
With the First Word News, I'm Ruchika Gupta. Huge deal in the media industry today. AT&T will get $43 billion under an agreement to merge its media assets with Discovery. The deal creates a company with channels ranging from CNN and HBO to HGTV and the Food Network. And it marks a retreat for AT&T's entertainment industry ambitions after years of working to assemble telecom and media assets under one roof. The European Union has reached a truce with the US over metal tariffs. The results, iconic products such as Harley-Davidson motorcycles and bourbon whiskey won't have tariffs doubled next month. The dispute began back in 2018 when former President Trump imposed duties on steel and aluminum from Europe, Asia and elsewhere. The EU retaliated. Now the two sides have agreed to discuss the metals issue. And Israel has stepped up its attacks on high-ranking commanders in the Hamas movement that rules the Gaza Strip. No word on casualties yet. Israel said it attacked terrorist infrastructure and weapons storage locations. Meanwhile, Hamas continued to fire rockets at civilian areas in Israel. The US and other world powers have called for an end to the violence. Israel's Prime Minister Benjamin Netanyahu said action will continue as long as necessary. And more revelations coming out in the wake of Bill Gates' impending divorce. Microsoft conducted an investigation into Gates' involvement with an employee almost 2 decades ago after being told in 2019 that he tried to start a romantic relationship with her. The company investigated but didn't reach a conclusion because Gates stepped down from the board. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Okay, day traders, are you ready to play stop on profit for British pound? We purchased, as you remember, last week. Position was opened last week. So right now it's time to play stop on profit. And we're going to play stop on profit on 140,905. All right. 140,905. Just right here. If anything will change, we will. If it will change direction, it means we will close position in profit. In our case, we will close position with 200 pounds in profit. In your case, you had to, before you trade, you needed to find out from your broker how much broker pays you per pip. Okay. That's it. If you want to get a strategy, you can go to company.co.uk and you will get the strategy. Otherwise, you can follow our trades and you can make your as well profit based on by following our trades. Okay, follow, copy, and make a profit. Stay safe, guys.
Visit Bloomberg.com webinars.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is a company that is in the telecom business where there's a tremendous need for capital investment. And if you can't make the capital investment, your core business falls behind. And I think they're at least coming to terms with now they have to clean up the mess.
That was Craig Moffat there, Moffat-Nathanson, senior research analyst, reacting to the deal of the morning. AT&T spinning off its media assets and tying them up with Discovery. David Zaslav, the CEO, will be dealing with that entity as it combines. From New York City, this is Bloomberg. Alongside Lisa Abramovich, I'm Jonathan Ferro. Your equity market coming off the back of a week of losses, and we add to them. The S&P 500 declining by 20 points. We're down 0.5% now, going into the opening bell.
Let's play stop and profit for British pound, even better to our advantage. In this case, I'm going to play stop and profit to 140.8 to 885. Okay. Okay, even lower, I will play stop and profit 875. Just here. Okay, it will give us £500 in profit. Okay, please copy this stop and profit, and please place. Don't be a hero. Don't try to wait until you will get better price. It's all about day trading. Relatively based on small amount of profit, we make per day quite large gain. Okay. Speak to you later, guys.
Fusek, Jones Day, Global Chair of M&A. Bob, great to catch up with you, sir. I can talk, I promise you. I'm in a cheap seats. So I'm going to read out your line. I give AT&T a lot of credit for willingness to react, even change course rather than worrying about critics in the cheap seats. Moi. Anybody who says this is a failure hasn't paid attention to the tremendous changes that have occurred so suddenly. Just build on that if you can, Bob.
Yeah, I think, there's no question because of the timing, people are going to say, oh, this is a mistake, and we've the new CEO at AT&T and all that stuff. But, standing back from what we've been through, it's not just a couple of years that have passed by. It's an extraordinary period. And particularly in streaming, the game has changed. Two biggest competitors, you heard from the analysts earlier this morning, they've got almost 4 times as many subscribers as the AT&T does. So putting things together and allowing that business to bulk up on its own, taking some money out, which is one of the beauties of the reverse Morris trust structure in the process, to be able to help, deal with the great debt load that AT&T has with just a conversion to 5G and all the rest of it. That's smart. And I would say, sounds odd to be talking about telecom with this adjective, nimble, responding to the circumstances.
Well, let's add to that. If you were at another company this morning, I wonder how nimble you'd need to be. For some of the smaller competitors, what do those conversations look like this morning for your world? Do they have to get together and get together quick?
Well, there's a lot of that going on anyway, and certainly the way this activity works, when there's a big headline grabbing news, it does accelerate things. But frankly, for a variety of reasons, the M&A market has never been more active than it is right now. Just talk to anyone in the space, and I think they would say that. Now, is it going to continue? Yes. Is this deal by itself going to change it significantly? No. But there is something about this headline grabbing activity and the willingness to move quickly and the willingness to take a step that, I bet in the boardroom at AT&T, people would say, oh, gosh, after all, we had these activists just a little bit ago. Are we going to be criticized again? Well, okay. They basically said, okay, we'll deal with that. So that may have a psychological impact on other companies.
Bob, You know, I was talking with John earlier about how the shares are up so much pre-market for Discovery, even though there's so much hope baked into this trade, even though, as you said, this industry has been under so much dramatic change, and it is hard to know exactly the dramatic changes that are upcoming as we adapt to a streaming world. How do you determine when an M&A transaction is something that is a bull market product that is frothy, that will be regretted in the future, versus something that really has legs?
Well, that's true. That's certainly hard to predict. And if I could predict that, I wouldn't be a lawyer. That's for certain. But you know, when you look at it from the Discovery point of view, I mean, in order for this deal to work, the company in Discovery's position has to be smaller. It's a lot smaller, obviously, and it's very different. You know, Discovery is known for a different kind of activity. And we're talking about the news, not only just the news, but news that everybody knows about and all sorts of other things in terms of the AT&T assets. So it's really a game changer from Discovery's standpoint. I can see why, from their point of view, they said this is an opportunity of a lifetime.
Yeah, and meanwhile, John, I just...
including, and their CEO is running the business, but one of the things that's kind of unique, but I suppose reflects the relative equity splits here, is that AT&T is actually appointing a majority of the board. Usually, it goes to the other company.
Meanwhile, John, this from Craig Nathanson. Craig Moffat, excuse me. Moffat-Nathanson, excuse me. He noted that what is not being reported is that AT&T quietly slipped in a huge dividend cut. Shares still up.
Targeting a dividend payout ratio of 40 to 43% on anticipated free cash flow of $20 billion. Craig Moffat pointing out that the dividend has been cut from $15 billion to $8 billion. Now, has that just not been picked up on, or are we just happy with what we're hearing elsewhere?
Or is this not the issue that people are looking for? They're looking for, as Bob said, a more nimble company that is more capable of dealing with its debt structure.
Certainly the more constructive view of what's been going on at AT&T. Bob, always appreciate your insights, sir. You know that. Robert Profusek there. Jones Day, not John's Day. Jones Day, global chair.
It's always John's Day. You're on Bloomberg surveillance.
Not quite. Maybe more so when TK's not about.
Perhaps.
AT&T
He was jump on that
up
one.
by 2.7% in the pre-market. Discovery right now, Lisa, up by 11.64.
I do wonder, though, how you invest that much money at a time of such dramatic change. I mean, the change isn't over, and we haven't seen the shuffle out here. And it just raises a question, especially given AT&T's investment just 3 years ago, of how much could change in the next 3 years, especially if 5G takes off.
Anticipation. You've got to anticipate those moments, haven't you?
Well,
was it really that unanticipated? Was it really that surprising?
You mean the streaming?
The transformation of the last 4 or 5 years?
How quickly it was accelerated, perhaps, yes. And the frictions that are absolutely accelerated there. And one of the big questions, frankly, in my mind, is what happens with sports? Will sports abandon the cable networks? And if they do, how much does that reshift the entire landscape overnight?
That's all I watch now, news and sports. News and sports.
Did you see the Tottenham goal?
Tottenham?
No, no.
Tottenham?
Actually,
Liverpool?
no, the Liverpool
you sound
goal.
worse than TK.
Yeah, I do.
Did you watch the goal?
Did you watch the goal? He got the head into the goal.
Yeah.
It was pretty good.
This is like a sketch, honestly. From New York City, 4150 on the S&P. This is Bloomberg.
closures and the complexities of COVID, it became apparent that if we could provide this course in South Australia, it would benefit trainees of anaesthesia in the state.
Feel like I've got some excellent skills to take away from the course, and I'm very grateful that it could be run in Adelaide.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minutes away from the cash open in New York City this morning, live on TV and radio. Here's your price action. The S&P 500, 41.51, down about 0.8%, 0.4% rather, 0.9 on the Russell, down about 0.6% on the Nasdaq 100. Goldman Sachs and David Kostin putting out a note over the weekend. My next few comments inspired by that note. Think about the future here, the potential of higher real rates, higher taxes maybe, and decelerating growth later this year. What does the equity market look like later this year with all of that in mind? Question that people are posing at the moment. So switch up the board and get to real yields in America. Just for Lisa.
Thank you.
Your 10-year real yield just rolling over the last couple of weeks, Lisa. Now negative 91 basis points. We had a bit of a move higher, substantial move higher for that matter, going into March. And then Lisa, just recently, just rolled over again.
The idea here is you're not getting compensated for inflation expectations that are increasing dramatically. And I really do wonder where the Fed comes into play with this. Let's say they do start talking about tapering. What happens to this negative real yield? Does it get that much less negative, and what does that do to markets?
You'd have to say, just intuitively, that's what you would expect. That's what you would expect, but I've got no idea. This is what your nominal yield looks like right now. 2s, 10s and 30s in a treasury market. Switch up the board. We'll finish on that just briefly. With futures declining, nominal yields right now climbing by almost a basis point on 10s to 163.52. On 30s, up about a basis point to about 235. Can we say this Monday, outside of that discovery deal, Lisa, no real drama in this market at the moment?
No real drama. I would say that that is true, although I would say under the surface, a lot of drama. And I will say the other thing is the drama of getting back to the office. We've all been in the office for a long... Okay, okay, here you go. Here's your soapbox. Patagonia vests, go.
Well, I've got nothing against Patagonia. I just wish that...
Just the vest.
We're getting back to work. We should celebrate that and embrace it in a way that's just a little bit more, you know, smart, energizing.
Thank you.
You want to go into a room with a client, do you want to go in with a Patagonia vest and no tie?
We need soft music underlying this, you know, basically, you know,
I see it in Midtown all the time. I see it in Midtown all the time. Come on.
Kaylee Lyons is on Patagonia Vest Watch, and let's get her take. Jonathan Farrow, thank you, our fashion correspondent for Bloomberg Surveillance, joining us. So Kaylee Lyons, you are outside JP Morgan's New York offices. They are going to be reopening their nationwide offices. The New York office has been open for the entirety of the pandemic. Why is this a significant moment in this reopening trade, in this reopening of corporate America?
Well,
obviously, Lisa, JP Morgan is the largest U.S. bank. It really is a bellwether for the U.S. financial industry, and it was the first to mandate that all employees do return to the office, the first to give that timeline. JP Morgan CEO Jamie Dimon, of course, doing so last month. He has said that he expects all employees back in the office on a consistent rotational basis by early July. But of course, that starts today. As you said, this headquarters where I am standing right now has been open for the duration. Jamie Dimon himself has been coming into work here since last June. But in other places like Ohio and Texas, offices still were partially shuttered because of COVID-19, and that changes today. So it is a step forward. Now, of course, JP Morgan making this move a little bit sooner than other banks. Goldman Sachs has told employees to expect to come back to the office by mid-June, but others like Bank of America and Wells Fargo aren't looking at a return to office until around after Labor Day, guys.
In many ways, Kelly, it's not about the business behind you. The business behind you has done tremendously well in the last 12 months. The individuals working there have carried on working for the most part. We've seen record profits. It's about the businesses around that headquarters behind you. It's about whether they'll recover. And as I'm sure you've seen, many people have seen walking around Manhattan, those companies, the cafes, the places you would go to get your coffee, the places you would go to get your lunch, they have been on their knees struggling now for a year and more.
No, that's absolutely right, John. I mean, the first thing I saw when I walked up to this building is the guy running the coffee cart that is right behind me, and thinking about what his business has been like for the better part of the past year and some change. So that is definitely a factor. A cafe standing right next to where I am is not open at this point in time. So it is obviously going to look different in Manhattan when these bakers return to work, but they are indeed returning, John. And I will say that I live down in the financial district. Anecdotally, things have gotten a lot busier over the past month or so. So the renaissance, perhaps you could call it, for Wall Street is starting to begin anew. And of course, here in Manhattan, we are making further progress towards reopening. Starting on Wednesday, capacity limits will be lifting. So as long as they can keep 6 feet of social distancing, keep that social distance, businesses can open at whatever capacity they can under those circumstances, and that could help many businesses here in the New York City area, John.
Kelly, thank you. We'll let you go. Kelly Lyons there, Surveillance Early Edition anchor, down near Battery Park over the weekend. Absolutely packed. Great to see. Absolutely rammed, Lisa, as we get back to business in many ways, more ways than one, in New York City and elsewhere too. In the equity market, we fade on Discovery, Lisa. You noticed that. We're down by, off the highs, we were up by 17, 18%. We're off by, what are we now, 9.68%. We're positive in pre-market. We've really faded in early trading.
Again, there's a lot of hope baked into this trade. As you start to look at the financials, you have to extrapolate out what the competition is going to look like and what's actually baked in. $3 billion of synergies, read cost cuts, just to channel Tom Keene, job cuts as well. You wonder how much is baked in terms of the amount of money that they save versus the anticipated market share that they could gain.
The move in AT&T fading too. T is now up by 2.39%. Let's bring in Chetan Nair, Morgan Stanley Chief Global Economist. Chetan, arguably you and a team with one of the biggest calls, I think, for economists in the last 12 months, just to be out there, bold, constructive, confident, optimistic about the future when many people weren't. That call's played out. Most people are on board. What's next, Chetan?
Well, Jonathan, I think the next one is that we're going to see a big pickup in the capex cycle globally. That's in the US as well as the rest of the world. And in terms of the numbers that we are highlighting is that the capex numbers globally will rise by about 21% by end of 2022 compared to pre-COVID levels. And in the US, it will rise by 16% compared to pre-COVID levels. And this is something that we have not seen in the last 5 cycles. In fact, even in the 90s, which was known to be the last big capex cycle, we're going to do better than the 90s cycle as well. So yeah, looking forward to a strong pickup in capex now going forward. That will be the key driver to our global growth story, which still remains constructive as well, Jonathan.
How much could this capital expenditure boost GDP globally for the years after the rebound that we're seeing currently?
So, Lisa, it will depend upon the infrastructure spending more than the capex that we're expecting to see pick up in terms of business capex. And together with this structural shift in infrastructure spending that is going to come up, as well as the pickup in capex, we think the global GDP could be boosted by about 0.2 on a structural basis. So that's the assumption. But really, I think the bigger story is, that this is going to be strong 12 months to 18 months because of this pickup in capex.
How will shareholders respond? I mean, right now, just based on the AT&T and Discovery transaction, it seems like investors want to see bold moves. They reward them if they see the potential for market share accretion. Do you get the sense that investors really want capital expenditures and are much more willing to endure perhaps less of a cushion of cash?
Well, I think this is going to be an extremely different environment compared to what we had seen in 2012 to 15 when there was a global...
Okay, traders, position close on British pound. Let me show where it closed, just right here. Okay, we had over the weekend this position and we close it. Okay, we have £500 in profit. Well done, guys. Let's move on. Let's look for another chance, another opportunity to trade Forex pairs. Well done.
Should be rewarding those companies when they take up a capex in a big way.
Chetan, being familiar with your research, you had said previously that you think these inflation pressures, price pressures, will persist into next year. Is that still your view, and how does it reconcile with this big capex cycle you're expecting?
Yeah, Jonathan. So I think in some ways, the big pickup in capex will put additional pressures on inflation outlook. The way you have to think about this is that this pickup in investment will drive demand for labor, and it is coming in much faster than the previous cycle. And so you are going to see tighter labor markets with pickup in investment. And at the same time, we are going through some accelerated restructuring, which means that the natural rate of unemployment has moved higher. And additionally, this cycle, as you know, we've seen a large amount of job losses in the low-income segment. And therefore, when the Fed is looking at the headline unemployment, it is going to overestimate the underlying slack and pursue a easier monetary policy for longer. They are all looking for inclusive growth and want to have a high-pressure economy, which will bring back that low-income segment back into workforce. But what that will mean is that from a demand side, you have a big pressure with strong job growth, and on the supply side, you have these restructuring aspects, which will put wage pressures, and therefore inflation will also come back much early.
Chetan, just quickly, at this point, just to jump in, because we only have...
Also, guys, as you can see, we closed position on Bitcoin. As you can see, we closed just right here. So great. You have to calculate. In our case, we have 1.5% in profit. Okay, so this is £1,500. In your case, how much you earn per percent? How much you lose if it goes against you? Okay, if you want to find out more how much you need to invest, who the best broker to use, you need to get the strategy. Please go to company.co.uk and get the strategy, and you will understand, you will see how we trade, you will use our strategy, and you will start making profit not only on 6 screen pairs. I can show you right now on our screen. You can make a profit on other Forex or indices or stocks. Okay, good trade, well done. I'll speak to you later, guys. Stay safe.
Stuff, as always, the team coming together and giving us some things to think about. Chetan there, Morgan Stanley Chief Global Economist. Coming up on the programme in the next hour, as I count you down to the opening bell, I'll catch up with Richard Bernstein, Advisors founder and CEO Richard Bernstein. We'll do that a little bit later from New York City. Happy Lisa's back. This has been fun, Lisa.
It's great to be back.
Thank you.
Nice to be with you.
Nice to hear you a touch bullish too.
Well, I
don't think it's going to last.
Give me another 10 minutes.
I'll see you tomorrow morning.
I'll see you tomorrow morning.
Tom Keane will be back with us tomorrow as well. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. A blockbuster deal in the media business will create a formidable rival to Netflix and Disney. AT&T has agreed to spin off its media operations in a deal with Discovery. The agreement will merge assets ranging from CNN and HBO to HGTV and the Food Network. AT&T will get $43 billion. Discovery CEO David Zaslav will run the new entity. The chances of President Biden getting an infrastructure bill through Congress with support from both parties are rising. As earlier today, Senate Republicans are set to deliver a revised offer that includes roads, public transportation, and airports. Still, disagreement over how the legislation will be paid for could kill off any deal. And in the UK, Chancellor of the Exchequer Rishi Sunak isn't convinced by President Biden's plan for a global minimum tax rate of 21%. Sunak and his team are concerned the rate may be too high over the long term. Instead, the UK wants to focus on measures to make big multinational companies such as Amazon pay more of their tax in countries where they operate. And that long-anticipated air travel bubble between Hong Kong and Singapore has been delayed again. The quarantine-free air travel arrangement was first set to start last November, but it was delayed by rising coronavirus cases in Hong Kong. This time, the postponement is blamed on a surge in infections in Singapore. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Lumber prices across the U.S. are skyrocketing. A 60% surge this year sent prices to a record. And analysts, they aren't expecting any relief until late 2021.
If you can get your hands on it, you're going to buy it, no matter what the number is. And the numbers are getting higher and higher.
Tightness is acute across the entire timber supply chain. Sawmills have had trouble ramping up fast enough to meet demand, while trucking delays and worker shortages at lumber yards have added to the cost. The summer peak of U.S. home building is expected to deepen these supply constraints and keep home prices red hot.
What's happening is lumber's going up, insulation's going up, stucco's going up, concrete's going up, and that's getting passed on to the consumer.
According to the National Association of Home Builders, wood costs have already added more than $24,000 to the price of the average new house. Lumber prices are expected to stay elevated for months to come.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
The importance of computing in all products is just going up and up and up.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
game changers, the vaccine, but also us finally getting a grip of test trace. 1 out of 5 jobs are in hospitality and culture, and it's possible to have a great time, to protect jobs, and to make sure the virus doesn't spread.
That was Sadiq Khan, London mayor, talking about the reopening of the city, a cautious reopening, as leaders around the world try not to set back their communities as they try to move forward and reignite their economies post-pandemic. As Tom would say, this is a joy, and this truly is a joy. Heather Boucher, a member of President Biden's Council of Economic Advisors, joining us now after the president did release an announcement talking about a child tax credit as part of the American Rescue Plan that would start going out very soon to families that qualify. 88% of children in the United States automatically do fall under this provision. Heather, can you give us a sense of what this child tax credit actually is and why you think it's important?
Well, thank you, Lisa. It's really exciting today that the president has announced that this new child tax credit will be directly deposited in most accounts for families with children starting July 15th. That'll be about $300 for children under the age of 6 and $250 for families with children over the age of 6. That's up to those amounts. And so this has been an important part of the American Rescue Plan to help families, especially help families with children, which we know have these higher expenses than other families, but to help them make ends meet. And it's very exciting that these payments, instead of coming once a year with your tax refund, they'll actually be directly deposited or sent out every month from starting in July.
So this is part of the $388 billion American Rescue Plan, which is only funded for so long. Basically, these will run out, and it really raises a question: how much is this a template for what the Biden administration is trying to accomplish later in the year as it moves towards some of its child and families agenda?
I think that is a great way of thinking about it. We thought it was really important to do this year, coming out of this crisis when so many families have been struggling so much. But this is a really good policy in general. A lot of other countries provide child allowances, and the child tax credit is a version of that. It can help families when they need that extra help the most, and it helps all kinds of families. So any child can get this tax credit. So it'll be an important support for family budgets. Now, of course, as you mentioned, Lisa, this needs to be extended, and it's included in the American Families Plan that the president launched just a couple of weeks ago.
So if this is used as a template, and just John Farrow has been talking about this a lot, as far as what the cutoffs are, how categories are going to be defined by income in order to receive supplemental aid or perhaps higher taxes on the other side. And for the American Rescue Plan, it was $160,000 for couples filing jointly and $80,000 for individual. Is that the annual salary that you expect to be the basis of additional plans later this year from the Biden administration?
Well, all of this is still a work in progress. We're just getting the program up and running, but certainly that is a starting place because that's what we're already doing. These decisions will be negotiated in the months to come, but I think it's really important to keep in mind that all kinds of families need help when they have little kids, and we know that families, experience this extra burden, and so this is support that will help them. One of the things that's actually most exciting about this particular proposal is that scholars estimate that it will have a significant reduction in child poverty, and particularly child poverty for Black and Latino children. And so I'm eager to see how that works in the months to come, to see the data come in. But I think it's a really important policy that we can get out there for all of those families who need it.
As somebody who has raised 2 boys, I understand, and with child care, you know what a juggle that is and how challenging, frankly, how expensive it is. There is a question when you say the data rolling in. What data are you going to be looking for to view this as a success, to help push whatever additional programs Biden plans to outline in future plans?
Well, in the years to come, we'll be able to see this show up in the income statistics that the Census Bureau collects. Now, we won't get those numbers until far into 2022, but so hopefully we will have passed the American Families Plan before then. But certainly we'll be watching that data as it comes in to see what happens to child poverty in the United States. The United States has higher child poverty than most other countries of our economic level, and this is an important step forward to really helping those families with children make ends meet.
It's a noble goal, and just sort of broadening out to the American Rescue Plan, there is a question of how well it's working and, frankly, how much it might be hindering indirectly some of the recovery. And I'm thinking in particular about the unemployment benefits, the idea that the enhanced jobless benefits have some people ramifications like that. How much do you buy that argument?
Well, the rescue plan that was put in place at the beginning of the year was designed to help us get through the pandemic, and we're not out of the woods yet. Almost 6 in 10 adults have received at least one vaccine shot, and we know that only about a quarter of people in their 20s and about a third of folks in their 30s have received their vaccines. So as we're getting everybody the shots, getting folks back into the labor force, those unemployment benefits are an important lifeline for those folks who are not yet back at work. So we need to make sure that that we provide people what they need while they're out of work, while they're searching for a job. Of course, we're still more than 8 million jobs below where we were pre-pandemic. Jobs are starting to come back, and we've had a lot of progress there, but we still have a long ways to go. And that's what unemployment benefits are for, to help people while they're searching for work and to help folks during this pandemic.
Well, Heather, just to sort of wrap up here, though, we got that retail sales report on Friday that was highly disappointing, and some people pointed to the fact that some of these jobs cannot be filled. They cannot find the workers to come back to fill those roles, and that is what's hampering some of the sales that otherwise would be taking place to encourage commerce. I mean, how much do you weigh these factors as you do weigh the health considerations, but also the economic ramifications?
Well, here's the thing. We don't want to make too much about any 1 month's data point on the plus or the negative side. We know that this recovery is going to be a little bit bumpy. We turned off the economy really quickly in the spring of 2020, and we're turning it back on now. And so giving ourselves the time for everyone to get their shots, to get back into the labor force, to address the supply chain constraints that we know are happening across the economy, this is what's happening right now. But you know, when we look at the trends and the larger, when you put all the data together, what you see is an economy that's moving in the right direction. Created over 500,000 jobs per month over the past 3 months. That's more than the 60,000 per month in the 3 months prior. And we're moving in the right direction. So I think that it seems like the policies are working. It's helping families and businesses get up and running, and that was the goal. And now we just need to get those vaccines out and then make sure that we're connecting those workers back to employers.
Heather Boushey, thank you so much for being with us and taking the time. Heather Boushey, Council of Economic Advisors member for President Biden. Right now in the markets, we could see no drama, as John said. However, you are seeing a deterioration, particularly in the NASDAQ, down 0.5 percentage point in pre-market trading, and in the S&P down 0.4%. Meanwhile, the drama, if there is any drama, is in AT&T and in Discovery. Discovery shares up more than 9% ahead of the open after agreeing to acquire AT&T's media assets. Coming up today at 3 p.m., Discovery CEO David Zaslav and AT&T CEO John Stankey joining to talk about that combination. This is Bloomberg.
Have you ever thought of bottling your happiness? And you know, you could make a lot of money if you bottled your happiness.
Yeah, you know what it is? It's just gratefulness. I should have died in that field in Iraq.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
From New York City for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now. Equity futures down 17. We declined 0.4%. And we begin with the big issue. Growth missing to the downside, price pressure surprising to the upside.
Month to month, we will see some big volatility.
Volatility in the data to the upside and to the downside.
The misses are going to be kind of unprecedented.
Consensus will be a long way from actuals.
You know, you have labor shortages, you have supply chain interruptions.
Pent-up demand intersecting with pent-up saving with a reopening.
The data is going to bounce around.
Demand is coming back now.
The vaccination ended up going a lot faster, especially in the U.S., than anticipated.
We should expect a bigger range of uncertainty around expectations.
A little bit of, disjointedness.
Growth will definitely decelerate. You have to recalibrate. You have to focus on the trend.
The data right now is extremely noisy.
The data right now is extremely noisy. Let's bring in Morgan Stanley's Vishy Tripatur and Victoria Fernandez of Crossmark Global Investments. Let's start right there, Victoria. What is the big issue for you? Our expectations or the data itself?
No, the data itself doesn't bother me, Jonathan. I mean, we look at where we're sitting right now, and we have a pretty solid foundation. You've got a consumer with $1.5 trillion sitting in savings. We know the multiplier effect from savings is not that high, so we need to see that translate into actual spending, and that's going to happen as things continue to reopen. We're going to switch from that goods purchases that we've started to see come down to the service component of the economy, which is the major component of our economy. And so we really need to see that. I'm not concerned there. I'm not concerned with the labor market. I think those are, just as people are talking about transitory inflation, I think the issues we're seeing in the labor market are transitory as well, and we'll see that start to do better in the fall. So I do think we're sitting well with manufacturing, services, with labor. We just have to get out from underneath this pandemic cloud that really is affecting all the numbers that we're seeing.
What about you, Vishy?
I think we will see both upside surprises as well as downside surprises in the economic data. Just in the last 10 days, we've seen good evidence of both of that. I don't expect that to change, at least in the near term. But I think the key, I think, as Victoria pointed out, the underlying trajectory of the economy remains on very firm and solid footing. So we've just published our mid-year outlook, and our economists call for continued strong growth, because that's effectively our base case, that the global economy that is supported by the largest fiscal stimulus ever, very large monetary easing, and as Victoria pointed out, the highest consumer saving rates in history. You put all these things together, we are we add to that a significant rebound in capital spending, and we think we have a high-pressure economy that's well on its way.
Chet and I caught up with me and Lisa a little bit earlier. We caught up with your colleague, Vishy, and talked to him about that hot capex cycle that you guys are anticipating. And what I asked him is whether that actually alludes or at least attributes to the price pressures that we're seeing at the moment, or actually some kind of weighs on it and pushes it down. Which one is it?
I think it's a little bit of both. It is not just one or the other thing. It is the pressures we are seeing now, the supply pressures we are seeing will abate as things will as the effect of the capital expenditure will result in better supply chains. And so some of the supply pressures we think are going to be relatively transitory and will ease over the next few months. But I think the key point is the trajectory of the economy that remains on a very firm foundation and strong economy globally.
I want to turn to Michael McKee. Another week full of Fed speak, perhaps, Michael McKee, and another week being told it's transitory, I assume.
Yeah, you can play that drinking game all week long. The main interesting conversation is today, Rich Clarida, the vice chairman, speaking with Raphael Bostic, the Atlanta Fed chairman, down at the Atlanta Fed Monetary Policy Conference. They're going to give you the same message that we have heard, that inflation is transitory, the inflation we've gotten recently. But that's a question for them, because you look at what's been going on with the inflation expectations, something they watch very closely, and you can see the kink there on the right-hand side as people begin to worry about prices being higher. Now, the blue line is the the one-year inflation, rather, from the University of Michigan survey. People really think it's going to go up. And the question is, will they react to that by trying to get higher wages? Much of what happened in the CPI last week was basically reflation. Almost all of the big inflation numbers came in transportation. And you look at things like airfares, and you see that basically they had been stable for quite some time, and they're just getting back to a profit margin that they can live with. The same with lodging. Once those things happen, the Fed is betting it will all go away. And we do have a big week of data as well, much of it on housing, and housing prices have been going up a lot. We do have existing home sales, and we have the NAHB, the Home Builders Index. The problem with those is that, the good news with those is that we're seeing inflation in housing fall. House prices are still rising, but at a much slower pace. And the other thing everybody's going to keep an eye on is any indicator that gives us an idea of where the labor market is going, because the Fed, of course, has been following that closely, and until we see the labor market tighten up significantly, they're going to say, we're not moving our policy. That's what we're looking at.
And that script's not going to change. Mike, thank you. This economy's running hot. Demand is hot. Can supply meet it? We keep going back to that question. Morgan Stanley's Andrew Sheets said the following. He wrote, strong economic winds are bringing complications. It's a hotter, shorter cycle. Just 14 months from the lows, investors face early cycle timing, increasingly mid-cycle conditions, and late cycle valuations. Victoria, this is the real complication right now. Sebastian Page of T. Rowe Price said something similar to me this morning. I've got them written down. We're bullish on the economy. We're cautious on stocks. Can you reconcile those two things for us?
Well, you don't have the different sectors in the economy really all acting in one direction to say we are early, mid, or late cycle. And that's where people are trying to figure out which are the sectors that are really pointing us in the right direction. We think we're probably a little more mid-cycle at this point in time, because you're really not seeing those discretionary names, even though they took a short hit last week. You're not seeing them trend lower. You're not seeing that weakness from the consumer or an unwillingness to spend. We're seeing financials do well. So all of these things, plus the trend that we've been talking about already this morning for the markets to move higher, it tells us we're more mid-cycle. And so we think there's still some opportunities there, whether you want to look at reopening names, whether you want to use the pullback that we've seen in the tech names to get back in there on those oversold conditions from Friday. Quite a few people did, so we saw the NASDAQ turn around. I think that's what you have to look at instead of trying to use all the previous signals that we used to use, because we are in a totally different environment, and try to tell what we think the trends are going to be. And for us, the trend is going to be higher. We still think we have some room to run here, so we're looking more mid-cycle at this point in time.
Vishy, this is the work of your team. I'd love your reaction to it.
Yeah, absolutely. I mean, I think the valuations since there's indeed the economy is on, as I said, on a very sound footing, but a lot of that expectation is already in price. Take credit as an example. I think the valuations in credit, in corporate credit, are very much towards, tending towards the late cycle valuations. So, what we have done really in this outlook is we've gone from being overweight credit, we moved that to neutral. It's still a pretty decent carry environment in corporate credit, but the euphoria that we had about a year ago in terms of the best opportunity for investing in credit, that has faded away. So that's the net result is that we've gone from mid-cycle in terms of in mid-cycle to late cycle in terms of valuations. The real challenge, especially in risk markets, is valuations, what's already in price.
Vishy, within that neutral call, where are you less constructive, much less so? Is it investment grade or high yield?
We are less constructive, relatively speaking, on investment grade versus high yield. So we think there's still better opportunity in high yield versus investment grade. Within investment grade, we like triple Bs or single As. If that's basically how we're looking at. In fact, some of the more structured credit opportunities, we think there is still a pretty attractive opportunities in sectors such as CLOs, etc. I think that is where there is still attractive risk premia embedded in those markets.
Vishy, Victoria, stick with us. We'll continue this conversation. Got to get some deal flow. Let's cross over to Taylor Riggs at the market desk for more. Hey, Taylor.
John, it is the news of the morning, right? A $43 billion reverse transaction, which would help spin off AT&T's media assets and merge those, of course, with Discovery. Analysts pretty much across the board pretty bullish on their deal, saying that, well, of course, this helps AT&T by spinning off those assets. They can go back to focusing on their big core business. Discovery now, it becomes a real competitor to Netflix and Disney. And so you're getting a boost across the board, as you see. Finally, we want to stick with some other media stocks, and well, it is the Archegos loss, but it might be the George Soros gain. Of course, in these few stocks, the regulatory filings are showing that George Soros snapped up a lot of the companies that had a big sell-off tied, of course, to some of those margin calls with Archegos. It's Viacom, CBS leading the games, Tencent as well, VipShop and others helping to rise on the news, John.
Would any of this happen without the Archegos blow-up? I wonder. Taylor, thank you. Rosenblatt Securities saying the deal puts Discovery shoulder to shoulder with Netflix and Disney Plus seemingly overnight. More on this big deal a little bit later this hour. Coming up, the reopening process gaining momentum as more firms return to the office. JP Morgan taking another step towards a post-pandemic normal. That conversation up next with Vishy Tripatura of Morgan Stanley and Crossmark's Victoria Fernandez from New York City this morning. Good morning. 19 minutes away from the opening bell in New York City with equity futures slightly lower, declining going into the cash open. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Expect clear, concise conversation on Bloomberg Surveillance.
There's no vows in a digital future.
Come on, John, I just think it works.
It works for Brutus.
We've beaten this to death. Watch weekday mornings on Bloomberg Television.
The demand is definitely there. There's a huge and pent-up demand here for people to come and see family members that haven't been able to be meeting across this pandemic, as well as people who want to go on holiday as well. So the demand is definitely there. Now it's down to unwinding the restrictions to restart travel in a safe way.
Exactly right. We know the demand is there. Easing global restrictions, adding fuel to that demand. The UK continuing its reopening process today. New York City preparing for its own reopening on Wednesday, with a host of US states looking to the summer for a potential return to normalcy. Deja vu. I feel like I said this last year. Wall Street getting back to work today, with the nation's bank opening its office's doors. JP Morgan headquarters in New York. Standing there is Bloomberg's Kaylee Lyons. Kaylee, not the building behind you, it's what's happening outside of New York today for JP Morgan. Walk us through it.
Yeah, John, that's exactly right. The headquarters where I am right now has been open all along. The CEO of JP Morgan, Jamie Dimon, has been working here in the office since last June. It is the locations elsewhere, places like Ohio and Texas, that are reopening today. They had still been at least partially shuttered due to COVID-19 restrictions. Now, I would note those offices and these headquarters here in Manhattan will not be open at full capacity. There is a 50% capacity cap in place for the time being. But of course, this is really just the first step for JP Morgan bringing back its workforce, John. Jamie Dimon has said he expects all employees to be back in the office on a consistent rotational basis by early July. But JP Morgan, the largest of the U.S. banks, is really a bellwether for this return to office effort. Other banks will be following suit, John. Goldman Sachs has told employees to be prepared to return by early June. Others, like Bank of America and Wells Fargo, more like after Labor Day. But of course, John, this comes in the context of New York State and New York City specifically also accelerating its reopening plans here in Manhattan, here in New York State. After today, curfews will be lifted on outdoor dining, and then on Wednesday, capacity restrictions will be lifted so long as social distancing guidelines can be followed. So the reopening continues the pace, John. That is true for banks, but that is also true for the economy more broadly, John.
And it's getting warmer this week in New York City too, Kaylee, so that's good news as well. Kaylee Lyons, thank you. Back with us is Victoria Fernandez and Vishy Tiripator. Victoria, I said over the weekend that there seems to be a duration mismatch between our immediate vaccine-fueled desires and just the mechanics of revving up supply to meet them. And I just wonder whether our own personal biases, because many of the people that I speak to on Wall Street in New York have been vaccinated, are skewing our expectations, at least in the near term.
Well, we definitely see the demand side of the equation there, right? And it is the supply component that we're really missing. When we look at how the rate of vaccinations are going, obviously the rate per day is coming down some. I'm here in Houston. We have availability every day with no appointment necessary for children ages 12 all the way up through adult. So I think if people want to be vaccinated, they have the opportunity to do so. It's no longer a question of the supply. It's there if people want it. I'm not sure how this is going to play out in regards to the economy, because I think if you haven't been vaccinated, you're still okay going out and going to restaurants and bars and going to a movie theater. So I think that component is still there. We saw restaurants and bars now are only 2% below their pre-pandemic spending patterns. So I think that that's going to be pretty good. We're going to see rates continue to slow down on vaccinations, but as the mask rules start to relax, I mean, we saw Trader Joe's take their mask mandate away. For us in Houston, that's huge. They were one of the strictest businesses out there. So I do think the recovery trade is probably going to start to gain a little more steam.
I wonder what to do with treasuries right now, Vishy. Let's bring up the numbers. 2s at 15 basis points, 10s at 164, 30s at 235. We closed at 174 at the end of March. That was your high on a closing basis. We've seen 154. That was your low on a closing basis. And since the start of April, I think the average, Vishy, it's 162. We're at 164 on treasuries. And many people have been asking the same question. Why not higher? Why not, Vishy?
think they will be higher, but nothing dramatically higher. So our expectation is that by year end, we will be the 10-year Treasury as a benchmark. My colleague, our macro strategist Matt Hornback and team, they think that the 10-year yields will be 1.8% by year end, and with the yield curve steepening somewhat, somewhat more than the forwards. We think that a year from now, so middle of next year, second quarter of 2022, we might hit 2%. But I think that the key point here is that there is a lot of this expectation of the economic recovery, the level of inflation, etc., are more than already reflected in price. That's the reason we are not seeing dramatic spikes happening as economic upsides and downsides come through.
I wonder what that means for the curve. I assume you think it means a steeper curve. This is what JP Morgan's Ian Steely had to say. Take a listen, Vishy.
The Fed has been very clear that at the moment, the most important indicator they're focusing on is jobs. And they want to see the amount of jobs that were lost after the pandemic be recovered. If that doesn't come through, they've told us they're not going to be normalizing policy. So from a yield standpoint, I actually think it means yields are higher in the long end, but probably steeper curves with the Fed on hold for a longer period.
Steeper curves, Vishy. Does that resonate with you?
Absolutely does. We think that the 530 steepeners are the right play here, and we think this is a trade to be in on for some time. This is a trade that we have been recommending for some time, and we continue to do so.
Banks have done nicely recently, Victoria. Just to build on Vishy's words around the steeper yield curve, do you stick with the banks trade, with the idea being that this plays out in the way Vishy describes, the way Ian Steely describes?
We do anticipate that we're going to see a steeper curve, so I agree with Vishy on that component of it. But when we're looking at financials, we're not necessarily looking at so much of the big banks. We do own JP Morgan because we think they're kind of the best of breed right there. But we like to play financials a little differently. We like to play it through a MasterCard or a Visa, through that credit card component, or even some kind of fintech component there. We think when you look at credit card spending over the last couple of weeks, we continue to see those numbers trend higher, getting back to pre-pandemic peaks. We think that's where the opportunity is online purchasing continues. As people get out and do start buying concert tickets and start going more places, they're going to be using those credit cards. So we like to play financials through that component more so than the big banks.
Victoria, what is it about that story that you don't think is fully realized at the moment, already, right now?
Well, I just think when you look at the reopening trade that's out there, we've had so much volatility. At the beginning of the show, you played that montage, and I think volatility was the word that came out of every person's mouth. And because we still have some headlines coming, we saw headlines out of Asia over the weekend that they're looking to curb some of their activities because you're seeing more COVID cases come up and they don't want to see large spikes. So there is this volatility going on in the market right now. And for that, we think you need to take that longer term perspective. You need to be pretty particular on what names you want to use. You've got to do your fundamental work. They have to have strong balance sheets. It has to be a good business model. And we like to see some components of growth in the names that we're going to buy. So that's why when I say for financials, we're looking at some of the credit card businesses, it's because we do see more opportunities for them to shift and change. You see MasterCard talking about their ability to incorporate crypto, and that's a huge topic right now. So we think they still have a growth component there, and that's what we want to see, visible growth in these companies going forward.
Got it. Vishy, final word, conviction trade for you and the team.
Conviction trade for the trade is really is an MBS trade. We think that in the agency MBS market, it's a high conviction trade. That the valuation suggests that in shorting MBS versus 5-year treasuries is actually a positive convexity and positive carry trade. That's a very high conviction trade for us.
Something nice and vanilla for the equity audience this morning, Vishy. Thank you. Vishy Tripator there of Morgan Stanley, alongside Victoria Fernandez of Croxmark. Coming up, the morning calls, and later, AT&T and Discovery merging media assets in a new challenge for the likes of Netflix and Disney. That conversation with JP Morgan's Stephen Parker and Richard Bernstein of RB Advisors. From New York City this morning, good morning. We're about 8 minutes away from the opening bell. With equity futures on the S&P down 13, we decline a third of 1%. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Open about 5 minutes away in New York City. Equities are pulling back on the S&P 500 by about a third of 1%. No drama. Adding to the losses of last week, the Nasdaq off by 0.5%, down about 67 points. Over in Europe, the FTSE off by a third. The DAX, the equity benchmark in Frankfurt, Germany, totally unchanged, dead flat. Here in the United States, let's get you some morning calls and start with some analyst recommendations. First up, a call from Wedbush upgrading Children's Place to an outperform with a street-high 150 price target. The analyst seeing an impressive transition, setting the company up for post-pandemic success. That stock is up by about 5%. Next up, Mizuho, raising its price target on ExxonMobil to 66, a neutral rating. The analyst expecting strengthening global demand to push crude prices back to pre-pandemic levels by the end of the year. We're down to 60.51 on Exxon right now, down about 0.4%. And finally, Wall Street responding to the big merger of the day, of the morning. Citigroup upgrading Discovery to a buy after acquiring AT&T's media operations in a deal worth $43 billion in cash to AT&T. Coming up, more on that blockbuster deal. Netflix and Disney preparing for a new challenger in streaming. That conversation up next with JP Morgan, Stephen Parker, and Richard Bernstein of RB Advisors. 4 minutes away from the cash open. Equity futures in New York, just a touch lower. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
seconds away from the opening bell in New York City this morning. Good morning. Your equity market down 12 on the S&P. We decline 1/3% on the NASDAQ. We're down about 72 and off by 1/2%. The Russell underperforming, down 0.6%. The small caps lower by a little more than 13 points. There's your opening bell. Switch up the board into the bond market. Yields look like this on a 10-year. Up almost a basis point to 163.69 on 10s. In the FX market, euro dollar not doing a lot. Unchanged, 121.48, and crude advancing 0.4% to $65 and about 60 cents. That's your Monday morning price section of the market desk with your movers. I'm pleased to say back with us is Bloomberg's Kuni Gupta.
Well, good morning, John. Tech underperformance, that is still the story even after last week's sell-off. And you're not just seeing it in big tech like your Apples, your Teslas. You're seeing it even in semiconductor stocks. That broad weakness, that rebound on Friday, not really continuing today. So like I said, even Applied Materials, which actually saw a price target rise at Morgan Stanley, shares still under pressure. Once again, tech underperformance. I can't say that enough. I do want to take a look at crypto stocks as well, because tech isn't the only place getting hurt. After Bitcoin dived this weekend on those Elon Musk comments, you're seeing those crypto exposed stocks take quite a bit of a hit. Marathon is really taking the brunt of it, down nearly 11%. And that lastly brings me to those telecom stocks, because the big news of the day, of course, is going to be the AT&T spinoff. Good news for both AT&T and Discovery, which will be merging with AT&T's media business, John.
Better news for Discovery, apparently. Creddy, thank you. 39.47 on Discovery, advancing there about 10 percentage points in early trading. Story of the moment for the S&P 500, down about 0.2%. No drama. Early days, the IT sector down by 0.7%. Consumer staples, a BTIG Julian Emmanuel favourite, up around about 0.2%, just slightly positive. Let's turn back to the deal of the morning. Craig Moffett of Moffett-Nathanson weighing in.
It is a clear concession of defeat for AT&T. It just didn't work. They paid too much. So the question is, we know some cash has to come back to AT&T, but does enough cash come back to AT&T that it offsets the amount of debt that this company supported for them, so that they don't come out even more leveraged than they went in?
Let's get the numbers with Taylor Riggs. Hey, Taylor.
John, it is the deal of the morning, right? The deal of today, the $43 billion plan to spin off some of the Warner Media assets from AT&T, combine them with Discovery. We are hearing, though, that this is about 3 years after AT&T bought that business for $85 billion. Discovery, though, a huge competitor with Netflix, Disney. You have CNN, you have HBO, you have the reality TV strength of Discovery Plus, like the HGTVs, the Food Networks. The Discovery CEO going to lead that new company. Let's talk about what this means for AT&T, as we know the largest non-financial company that is the most heavily indebted. So from that perspective, analysts very positive. Citigroup saying that the deal makes sense. AT&T can improve its financial flexibility. Barclays saying that this deal helps AT&T clean up its balance sheet and then gain more credibility for its telecom turnaround plan. So a lot of people looking to reduce the leverage on the balance sheet for AT&T. And that, of course, has been some of the frustration with the stock and the underperformance relative to other media assets, as you can see on the terminal chart. Cowen, though, saying that after spinning out Warner Media, AT&T can get a higher valuation on a standalone basis than what is currently being reflected. Though Craig Moffett, as you nailed it at the top, and then of course Truist Securities coming out and saying that frankly this reflects AT&T's strategy to combine that media and the distribution. This shows that that was a failure, John.
Taylor Riggs, many people share that view, apart from Bob Profusek of Jones Day, who said this completely underestimates just how much things have changed in a really short space of time. He was a little bit more, let's say, constructive. Taylor, thank you. An important interview taking place a little bit later today, 3 p.m. Eastern time. We'll catch up with the Discovery CEO, David Zaslav, and the AT&T CEO, John Stankey. Do not miss that with the team at 3 p.m. a little bit later. Joining us now, Stephen Parker at JP Morgan Private Bank and Richard Bernstein at RB Advisors. Guys, I want to start here. When you wake up and see a deal like that on a Bloomberg terminal, in the news, in the journal, in the FT, our colleague Ed Hammond breaking this story over the weekend. What did you think, Richard, when you see something like that coming together?
Well, Jonathan, I think in certain areas, and I'm not a media expert, so I don't want to portray myself as one. In certain areas, you know, you do have consolidation underway. And as long as you have cheap financing, I know there was a question about AT&T's debt here, but as long as you have cheap financing, that's going to happen. Now, the question is, are rates going to go up? And does that speed up some of the other deals that are probably in the works as well, because you want to get the financing as cheap as possible? That's kind of the way I would look at it, given that I'm not a media expert.
What about you, Stephen?
I agree. I think this is the beginning of a trend. I think you've got a trifecta of factors that are supportive of more deals ahead. Richard mentioned cheap financing. That's number one. Number two, you have elevated equity prices. So to the extent that that's being used to fund these purchases. And then number three, companies after last year have built up really strong balance sheets. So whether it's the ability to take on additional debt or the ability to use cash that's been raised to get these deals done, we think we see more of it. And it's not just going to be about M&A. Companies after last year stabilizing the ship are also starting to increase share buybacks, thinking about increasing dividends. So we think this is the start of a trend.
I caught up with Vishy Tripatur of Morgan Stanley and Chetanaya as well, and both of them, Stephen, making the point that Morgan Stanley are looking for this huge capex cycle to kick off. I know Bank of America, from their research, super focused on that as well. Are you too, Stephen? Are you looking at that, a huge capex cycle starting to build?
Well, I think some of the disruptions in the supply chain that we're seeing right now clearly have identified places where we need more investment. After a decade where it has been more focused on buybacks, dividend, shareholder return, that investment in capex is going to be critical. I think what you've seen in terms of the performance of some of the more cyclical sectors is reflective not just of the near-term recovery that's underway, but some of those longer-term tailwinds in terms of an increase in capital spending.
Richard, I was looking at what you liked. Energy, materials, industrials, regional banks, small caps, a little bit of Europe as well. Richard, I think it's fair to say very bullish on the cyclical trade, the reflation theme. Is that fair?
Correct. Yes, very much so, John. I think, we've had record monetary stimulus. We've had record fiscal stimulus. We have more coming. The tailwinds are behind us. And if you think about just from a sentiment point of view, where is the day-to-day attention? The day-to-day attention continues to be on things like innovation, disruption, technology. And if you believe that monetary and fiscal policy are going to work, those areas are exactly where you don't want to be. Those were the winners when you didn't have all this, when we had a pandemic. Why would they be these cyclical winners going forward? So I think it's going to be, traditional cyclical leadership for the next several years even.
Richard, what you just said, though, is so important. That this isn't just a short-term trade. This is something you think plays out for several years. And when you said you have to work out whether they will be successful, whether policymakers will be successful engineering what they're trying to engineer. And I assume, again, Richard, you think they will be. Now, I want to understand from you what you're looking at to gauge why you think they will be. What makes you think they'll be successful?
Well, Jonathan, I think their definition of success and my definition of what I'm looking for coming out of this may be very different. I think the way we're invested, the way we're thinking of it in terms of increases in nominal growth, not real growth, but nominal growth, meaning the addition of real plus inflation. I think politicians are thinking in terms of real growth. I'm not sure that ultimately they will be successful in reaching their goal, but I think we may be successful in reaching our goal, if I can put it that way, that I think nominal growth is going to surprise people.
Got it.
Now, there was an interesting report put out by Bank of America Merrill Lynch that pointed out the average value market lasts 33 months, and we are in the 8th month. So if you think just about that, we're only a quarter of the way to the average. And I think people are way too willing to say that the value rally's over before it's really started.
Well, I've heard it. You've heard it. Rent value, own growth. The trajectory of this cycle will kick back into lower growth, and you'll want to own growth for the future. That'll be the cycle winner again. Stephen, are you on the same page as Richard?
We think in the near term, the cyclical story does continue to have legs. We talked about energy being one of our favorite calls at the moment over the next couple of quarters. A lot of people will point to the fact that the energy sector is up 35% year to date, but I say sometimes it takes courage to buy strength. And if you look back over the last 3 years, energy stocks broadly have still underperformed the market by over 80%. So I don't think it's going to be a straight line higher in terms of the cyclical trade relative to growth. I think that as we see this recovery, some of the comparisons in terms of the headline economic numbers are going to get a bit more difficult. So you're likely to see some fits and starts. We think that the cyclical trade does continue to play out.
It takes courage to buy strength. On energy, Stephen, is it more than just strength right now. We have ripped big time.
Again, it's a matter of the rip that we've seen over the last 6-9 months or so. When you expand back the investment horizon, that's a part of the market, talking about energy specifically, but cyclicals more broadly, that have continued to lag some of the more secular growth parts of the market. And so I think you need to have that longer term horizon. You need to think about some of those things that Richard was talking about in terms of the focus on nominal growth and the Fed's commitment to have a willingness to overshoot on inflation. All of those things are positive for cyclical parts of the market.
Richard, final word.
Jonathan, I think it's interesting. I'm asked almost every meeting I have with our investors, what inning are we in for the value rally? I have never at any time been asked, what inning are we in for innovation and disruption? I think that's a huge sentiment statement right there.
Yeah. Well said. Richard, you're going to stick with us alongside Stephen Parker. Let's get you some of the price action, some of the movers. About 10 minutes into the session at a market desk, here's Kriti Gupta.
Well, Johnny, we're just talking about the energy outperformance. It continues this morning as you start to see the S&P 500, some of those risk assets come back off their lows from pre-market trading. New York crude markets, especially WTI coming in hot and taking those oil majors with it, with Occidental really outperforming. Look at that 3% move. And if you're seeing big oil do well, naturally, the other major cyclical is going to be those material stocks as well, doing pretty strong here. And remember, this is coming after a pretty weak kind of session last week. And you also saw the likes of Freeport-McMoRan or the likes of Rio Tinto, for example, really underperformed last week. Today is really a turnaround story. Big oil last week was dropping 0.8% as well. Today, commodities broadly doing pretty well, John.
Kriti, thank you. Coming up on the program, the president's infrastructure push gaining some traction. Republicans preparing to deliver a revised offer as early as today. That conversation still ahead with JP Morgan, Stephen Parker, and Richard Bernstein of RB Advisors from New York City this morning. Good morning. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
We certainly need infrastructure in this country to remain competitive around the world. But with the Democrats and under the Biden administration, when everything is infrastructure, nothing is infrastructure. When you have electric cars, when you have elderly care, home health care, when you have child care, these are not this is not infrastructure by any stretch of the imagination.
The view from the Republican Party right now, the prospects for a bipartisan infrastructure bill is apparently still rising, but Democrats not holding their breath. The Congressional Progressive Caucus Chair, Pramila Jayapal, saying the following: "We can't wait for Republicans to deliver. The best solution is still to go with one bill and get everything done." For more from D.C. is Emily Wilkins. Emily, are we really facing the prospect of a bipartisan bill down in D.C.?
At this point, Jonathan, a bipartisan bill is still on the table. We are looking this week to Senate Republicans. Remember, last month they came out with that $586 billion infrastructure bill, just roads, highways, airports, that sort of thing. They met with President Biden. They've made some adjustments, and we're going to see them bring back an updated bill this week. We're also expecting to see another proposal from House Republicans as far as what they would like to see in an infrastructure package. Of course, the question is, can they get it done? Major sticking point right now is how to pay for this infrastructure. Republicans have said a hard no to President Biden's tax plan for raising corporate rates, and President Biden has said a hard no to user fees that some Republicans have proposed. That's definitely a big sticking point to work out. Some senators say that we're going to have until Memorial Day, and at that point, that's sort of their own deadline for whether or not they're going to have a bipartisan agreement. If they come to one, we'll see a dual tracking of President Biden's plan. They'll do the normal process for the infrastructure component, and then Democrats are likely to go at it alone using that budget reconciliation process to pass President Biden's plan that involves child care and an expansion of education.
Three issues here then: size, pay-fors, which is part of the size story, and then the composition, which is part of it all. Emily, of those three things right now, what's the biggest one? What's the biggest issue?
I think right now the one that everyone is looking for is pay-fors, because if Republicans and Democrats can't agree on how to pay for infrastructure, then it's done. Then there's nothing else to do. There's no way to move forward. And I think that's the most prominent thing that we're looking at this point. I know that, obviously Congresswoman Jayapal has come out very strongly in support of just Democrats going ahead and passing the package. But the fact of the matter is that she knows that there are moderate Democrats there who really need to go back home and say, look, we made a good faith effort to work with Republicans. At the end of the day, the goal for Democrats is to get something done. And I think there is some flexibility within the caucus on whether that means going with Republicans for part of it, or just if they can't go with Republicans, than being able to go it alone.
Emily, thank you. The latest on the infrastructure push down in Washington, D.C. The latest on the World Economic Forum. Headline just crossed on the Bloomberg. They will cancel their August Singapore meeting. That just crossed, for those of you that care, the World Economic Forum to cancel the August Singapore meeting. Let's bring in back our guests, shall we? Richard Bernstein and Stephen Parker still with us. Stephen, your base case for the next move down in D.C. I have to say it's confusing for me. It is for others. Is it confusing for you?
Yes, and I'm glad that we here at JP Morgan have a lot of people who spend their entire time focusing on things like this, so I don't have to. We think that ultimately there is going to be some sort of deal that gets done. We don't think it's going to end up being on either tail. There's going to end up being some sort of compromise. And we also have to keep in mind that while we think that an infrastructure package is critical, really long term, when you look at what's going on in our national infrastructure, to help avoid some of the disruptions that we've seen, we're also not overly optimistic in terms of what this might mean in terms of a short-term boost to the economy. We think that this will get done, but it's going to take time. It's going to play out over the next couple of years.
This was such a big part of the outlook for so many people on Wall Street coming into the new year, coming into 21. Richard, do you have a base case for what the next 12 months looks like and what we can expect from Washington?
Yeah, you know, Jonathan, I'm a bit more cynical than Stephen is. I hate to say it. I think that Washington, D.C. always looks towards the next election. So the question is what both parties now are being driven by the 2022 midterms. And how do you set the table for a victory in 2022? The Democrats want very badly to have this infrastructure bill because they really want the economy humming. We can argue, I mean, I'm been a fan of infrastructure for 15, 20 years now. I've lamented that Washington can't get anything done for 15, 20 years. But I think the Democrats want this because they want the economy humming going into the 2022 midterms. The Republicans want to hold it up as long as they possibly can so that the economy is sputtering. They don't want to have Joe Biden be able to say, come the 2022 midterms, look, we put the economy back on the right track. You've got a job again. Confidence is up. Re-elect the Democrats. That's what the Republicans don't want. So the Republicans are going to try and delay as long as they possibly can, and the Democrats are going to try and push it and make it bigger. Now, if you accept that premise, you can kind of understand what's going on. Personally, I think infrastructure is the most important issue facing the country right now. The reason that U.S. manufacturing has lost such dramatic market share for an extended period of time is because our infrastructure is dilapidated. We cannot compete in a global scale. And if we don't do something about this, the long-term outlook for the U.S. economy gets worse and worse and worse. The secular growth rate just keeps falling and falling and falling, as it has been doing for some time.
You've got to put some money behind that political analysis, and I'll go back to something you asked yourself about 10 minutes ago. Do you think the Democrats will be successful? Do you think the policymakers will be successful? And if you think they will be, where do you put the money with that in mind?
So Jonathan, I do think that we're going to have an infrastructure bill. I think it's going to be probably take a little longer to complete and be smaller than the Democrats want, but I think we will have an infrastructure bill. If you agree with that, I think the area you want to look at are small cap industrial companies. These are the companies that are going to be right in the crosshairs of those kind of programs. Right? If we do have an infrastructure program, they're going to try very hard to direct those funds towards domestic companies, right? You don't want to give it to some big European company or some big Asian company. That defeats the purpose. Yep. Our manufacturing sector, industrial sector is so undercapitalized, we think they're going to be the big beneficiaries.
Richard, we've got to leave it there. It's always good to see you, sir. Richard Bernstein there and Stephen Parker. Stephen, thank you. Let's get you some sector price action. Equities just rolling over a touch. Here's Dave Wilson with more. Hey, Dave.
Hey, Jonathan. I mean, yeah, rolling over a touch is a good way to put it. It's really kind of focused in the more economically sensitive areas of the market for the most part. When you go through the 11 main industry groups in the S&P 500, you see industrial, financial, material, energy stocks all lower in early trading. Technology with the biggest decline among those 11 groups, a lot of that tied into semiconductors and chip equipment, which have been arguably on a run lately because of the demand for chips, which isn't being met at this point. One area it's interesting to watch is communication services, which is actually lower, even in light of this deal, AT&T merging its Warner Media unit with Discovery. At least that's the plan. And what's interesting is it comes in an area within communication services that really has been on a roller coaster ride this year, specifically the media stocks. Now, you think about how the year has gone. You remember Discovery and also Viacom CBS were among the shares that ran up earlier this year because of Archegos Capital Management and all the buying it was doing. And then we saw the shares come down as Archegos unraveled. And now, I mean, you've seen a bit of a recovery, though today you're actually seeing the group lower. You know, put it all together, you know, and it's clear that this is an area which has had some volatility and may well have more as the year progresses.
Dave, thank you on some of the price action this morning. Coming up, your trading diary. This is Bloomberg. minutes into the session, equities down by about 1% on the Russell, down 0.6 on the Nasdaq, and off by 0.4% on the S&P. Here's your trading diary. What you need to be watching this week: the Fed Vice Chair Richard Clarida speaking at the top of the hour. Retail earnings from the likes of Walmart, Macy's, Home Depot coming up tomorrow. FOMC minutes on Wednesday, and finally on Friday we get a host of global PMIs to close out the week. From New York City to kick off the week, thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
The importance of computing in all products is just going up and up and up.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look into him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. If you do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you'll use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you.
Millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.